What happens? The government takes their tax, the government and then your 401k contribution. And then you get what's left over. True or not true? If you ran a for-profit business, wouldn't it be amazing to get customers to send you money before they even took theirs every 2 weeks for 10, 20, 30, 40 years? Wouldn't that be an amazing business for you? Absolutely. Do you even know how 401ks came around? We didn't all 401k is not in the Bible. It was not on the 10 commandments. It's not the 11th commandment. Thou shalt max out your 401k. That's not on there. It's only been around since the 70s. Before then, companies gave pensions. How many of you have a pension or know someone who has a pension or remember pensions? Back in the day, you went to work for a company and you spent 20, 30 years there. You didn't have to save money back then because you retired. You retired from work, and then 2 weeks later, you got your pension check. And the pension check was about as much as the work check. And then we're going to send that to you and or your spouse until you guys are both gone. That really was how it was. Now, do you think those pensions were very expensive to those corporations or not? Incredibly expensive. Paying people that don't work there no more? Are you kidding me? Forever, as long as they're around? So these Wall Street guys came to the corporations like, hey, we have an idea that can save you guys a bunch of money. Let's convince people that pensions are bad. Let's convince people that they don't want to have their money being invested with these boring, safe insurance companies. They could be making so much more money and making their own decisions, having that money in the stock market. So literally, Wall Street, the government, and big business all got together to come up with this idea of the 401k, the IRA. Guys, the data is in. It's been 40 plus years. Americans are not better off without pensions and 401ks. And they're not. They're absolutely not. They are tremendously worse off. It's a failed experiment. That was the biggest robbery of the middle class in history. And again, I'm not saying that 401ks are terrible. I'm just wanting you to see that how this thing that you've heard from your whole life, max out your 401k, max out your 401k, max out. You really don't know where this come from and why. There's a huge financial interest in Wall Street and from big business to have you do that. Okay. And the data is in. That's one example. Okay. There's many, many more things like that. But we're gonna jump in. We're gonna jump in. Okay. All right. So I've already started some of this. I've already started. So those three big decisions. One, do I need life insurance? If so, how much? And if so, what's the right type? Those will be answered today. We are going to talk about, we're going to spend the most of our time talking about the types of insurance, because that's where I think there is horrendous amounts of misinformation. If you already have life insurance in place, put it in the chat and let me know what type of policy that you have. There's either term, there's really only three main types of insurance. There's term, there's whole life, or there's this thing now called indexed universal life, or IUL. Put it in the chat and let me know. Okay. We're going to answer those three questions. All right. If I have time, I'm going to talk about this idea of using life insurance for a tax-free income. How many of you in your wanderings on the internet or TikTok or Instagram have seen people tell you you can get lifetime income tax-free out of life insurance? The rich man's Roth. You guys heard about the rich man's Roth, right? You heard about this, how wealthy people are getting, people are getting rich buying life insurance. Okay, these are things that are out there on the internet. Okay, we're going to talk about that. How many of you guys have heard be your own banker? You can be your own banker with life insurance. Okay, infinite banking. Is this true? How does this work? We're going to touch on that. Okay, but all that is going to be a bonus if we get to it. Holly, did you already give away some of the Amazon gift cards?
I gave away one Amazon
Okay.
gift card, and I think that you said maybe we'll do a couple more.
Yeah, so real quick, drop that link in the chat hall if because I'm very curious to know what questions you guys have. And so I can even tailor some of the content on the back end of this. So if you did not yet answer our quick survey, drop the link in the chat and we'll give away a few more of those gift cards at the end. But okay, guys, you ready to jump in? Can I jump in? Can I get started? All right. So first things first. First things first, I want to talk about wants versus needs. So Krim, can you get my whiteboard up? Can we get my whiteboard? Okay. So one of the biggest reasons we talked about financial marketing versus financial education, correct? How many of you that was already like a big eye, like that was already like a big eye opener? How many of you are like, oh man? Okay. Here's the next important piece I want to make clear for all of you that we're going to get into numbers. I'm going to show you, we're going to start like at 30,000 feet, and then we're going to get into all the way to the nattiest of nat details. Okay. Because, but we're going to start with concepts, and then we're going to get to like literally like the building blocks of this. However, in anything, whether it's, I would say in almost every area of life, I would encourage you to understand the philosophy, the belief systems and philosophy and perspective of the people that you are listening to. How many of you are part of some sort of faith-based community? You go to a church, or you maybe part of Kingdom Seekers, or you're listening to certain people. The people that you actually listen to learn from, not just make fun of. How many of you maybe watch some people just so you can laugh and make fun of them? I know none of you here because you guys are all good people. But sometimes, no, I'm just, but if you're actually listening to someone that you're learning from, let's say spiritually, how important is it that you understand the perspective at which they approach the topic? Is that a big deal or small deal? What is their perspective? What are some of their core beliefs? What is their philosophy about some of the most important tenets of spirituality? There are ministries that are all about the power of the Holy Spirit. There are ministries that don't even believe the Holy Spirit does anything anymore. This is just within Christianity. How many of you guys think you may have a different experience at these two different places? So it's whether it's spiritual growth and development, whether it's health, or in this case, financial, the most important thing you should be asking people or listening for is, what is their philosophy? What is their perspective on this whole conversation? What are the root beliefs and principles that they're coming from? Because what if I don't agree with those things? If you fundamentally disagree, and I'm not talking with the perspective, if you don't share the same perspective or values, write this down, values. Truth is truth, but then there's also values, and we all don't have the same values. Yes or no? And this idea of money and wealth really is really meaningless. I'd write this down. Wealth and money is meaningless outside of the context of my life, of your life. You guys know I talk a lot about the kingdom and God and spirituality and money and wealth and fulfillment and purpose, stewardship. God's never going to hold you responsible for what you did with the money in my hands. He's only going to hold you responsible for the money that came through your hands. And you've got your life, your family dynamic. Either you're married, not married, divorced or separated, widowed. Maybe you got 2 kids, no kids, 7 kids. Maybe you've got, do you guys understand how there's like between our ages, on this call right here, almost over 1,000 people, between ages. And team, if you can make sure that we're not capped at 1,000, because I bet you we are. Ages, gender, family dynamic, health history, financial status. We're all different. So it's super important that when you are listening and learning about anything, money, wealth, spirituality, health, what is the perspective? What is the perspective and philosophy of this person? What are their values? And do they align with mine? And I would say that most people today are getting information unknowingly from people that they are not in alignment with. Okay. So so this want and need thing, Krem, if you can come back to my whiteboard, this want versus needs is a really big deal philosophically. Philosophically, for me, you should always know when I'm talking to you, I am never really, unless I'm specifically making the distinction between wants versus needs, understand when I help people, which I don't get to do that too much anymore personally, but whether it's Rami on our team at Fortress, when we're helping people, we're almost always coming from the perspective of wants. What do you want? What do you want? Then we're going to then look at the reality and make sure that we're rooted in reality around, let's make sure that our needs are met. So we're not delusional. We don't just want to live in fantasy land. The kingdom is not fantasy land. Okay. So we want to make sure that the needs are first met, but we're not going to just stop there. We're going to then go into like, what do you want? What could you want? How many of you didn't even know you wanted something until you experienced it? There's a law. I don't know what this law is called. I don't know the name. I'm going to butcher this, but it kind of goes like this. A luxury once experienced has a way of becoming a necessity. How many guys know what I'm talking about? That's why I always tell people, don't fly first class. Don't take that upgrade. Don't fly first class because you're going to be ruined for first class and you're never going to want to fly coach again. And so I'm just helping you. I'm just helping you guys out. But that's the concept, right? You didn't think you needed to fly first class until you flew it once. And now you're like, oh no, now I need to fly first class. So our wants have an interesting way of becoming needs once experienced. Okay. Is this helpful? This is helpful. Okay. So now we're talking about the context of your life. So I have to give you guys this perspective. The first perspective is there are 3 main financial phases of your and my life. Okay. How many? How many phases of our life? How many? There's 3. Okay. To be really specific, I could say there's up to 3. Okay. And to be really more accurate, we're going to for sure, more than likely experience 2. But for most of us, the plan is 3. So who can guess what the first phase is? What's the first phase in your well, maybe not the first one, because the first phase in our financial life, I'm being technical, is we are dependent on our parents. Our first phase is we are just a liability, right? So I guess I should talk about like maybe our 3 adult phases, I guess. Right? What's the first phase as adults, as grown-ups, financially? What do we call that, right? We're going to work, man. You got to work. How many of you guys are working? You're working. Or you did work at one point. But how many of you guys you work? You didn't just wake up rich one day. You're not a Rockefeller. You're not a Kennedy. Yeah, me neither. Okay. So I'm still working. Okay. Now, work in the kingdom takes on a whole different meaning. However, this first phase, we are working. And we're working so we're earning money. We're earning money with our time, our talent, our skills. We're being good stewards of our time, our talent, our skills to work, to create value for people, create value in the marketplace, to solve problems, and we're earning money. And hopefully, what are we doing with some of that earned money? We should be saving and investing some of that, right? Saving and investing. Which means here we are at work. We get paid. And some of that money we spend now, right? And hopefully some of that money we choose to not spend now. We delay our enjoyment today. And we send that money into the future by saving and investing it in this big old bucket. And this big old bucket is simply a representation of all of your savings and investments. Okay? This is the future. How many of you are saving or have saved money for your future? Great. How many of you have arrived in the future? And then you have now, step 2, retired. Retired. Okay? Retired. What is retirement? Retirement is super simple. It just means, hey, I'm no longer actively working. I'm no longer taking my body to work. I'm no longer actively earning income with my body, with my time. I'm no longer putting money, I'm no longer sending money. I'm no longer saving and investing. I'm no longer sending money into my future. In fact, the future is here. I arrived in my future. I am now, whatever that, put in the chat your magic age of retirement. 65, 60, 72, 58, right? Whatever it is. But now you arrive at this phase, and now you're not putting money in. You're not earning and saving. You are selling and spending. You are distributing. There is money coming out. There is money coming out. Money is coming out. Withdrawals. You guys see this? Here we got money going in. Phase 2, retirement phase, when you can actually get to enjoy this money. Okay? You actually get to enjoy this wealth. That's making sense. That's making sense. Now, let me take a quick pause. All of the rules, all of what you think you've learned about money, investing, finances, all the tips and tricks that you learned, all of the financial strategies that you learned in phase one, right? While you were accumulating money, those same rules and strategies that helped you in phase one, those exact same strategies work against you and hurt you in phase two. The opposite happens here. Pedro, give me an example. An example is something called dollar cost averaging. How many of you know what dollar cost averaging is? How many of you have been putting money into a 401k or IRA every week, every year? You've been putting money into, well, that's what dollar cost averaging is. It simply means that if the stock market is going up and down like this, and you're buying in all the time, you're always putting in money, that means when the stock market goes down, you benefit. You guys see that? If you're buying shares of stock in a mutual fund and that stock price goes down, don't you get to buy more shares? Right? Let's say a stock's $100 and you invest $1,000 a month. How many shares do you buy? $1,000 buys how many shares of $100 stock? 10. Right? But now the stock market drops and falls. That same stock is now down to $50. Your same $1,000 investment now buys you how many? 20 shares. You see that? Simple math. $1,000 bought you 10 shares when it was at $100, but it bought you 20 shares when it was at 50. How many of you guys see that? That's how you benefit from dollar cost averaging. That's how you benefit when the market goes down while you're still working. Because you're actually able to accumulate more shares in those down markets. So when the market eventually comes back up, over time, you now have more shares to make money with. Does all that make sense? If a stock goes up, do you want to own 20 shares or 10? You'd want to own more. Dollar cost averaging. This is what all of you have done if you've been putting money into 401ks, IRAs over time. It helps you on the way up. If it helps you on the way up, what you must know now? It's going to hurt you on the way down. So now that you're pulling money out of the bucket, if you want $1,000 of income per month and the stock price is at $100, how many shares do you have to sell? You only got to sell 10 shares. But if you're retired and you need that $1,000 a month, I don't know, to live, food, prescription drugs, but now that stock went down to $50 a share. Now what happens? You've got to sell 20 shares to create the same amount of income. That's called reverse dollar cost averaging. Some call it dollar cost ravaging. It's going to ravage people's accounts and principal, because now, even if the market comes back up, you had to sell so many shares on the down that those are shares that are now gone. So the market can't come up. You can't benefit from the up market on shares you no longer own. Does that make sense in concept? And that's just one of several other of these. So these phases are very important. You have to understand, what is the financial strategy? What is the underlying principle that makes this work? And what phase does this make sense in? So then the last phase, how many of you guys actually want to retire one day? You want to retire and like the idea of possibly not having to work and just having your investments kind of give you income? How many of you guys like the idea of not having to work? Maybe you like Pedro, you'll never retire, but you at least want to not have to work till you die. How many of you guys are in that camp? Guys, I'm going to probably never retire, but I don't want to have to work till I die. Okay. That does not feel very awesome. Okay, great. How many of you would like to have a bucket of money or buckets of money where you know you can get income for as long as you're alive? Awesome. Same. Okay. Now, third and final phase, we can call this, I can just call it what it is, or I can make it sound good. What's the third phase here of our financial? What comes after retirement? Okay. Well, none of us are getting out of this thing alive. You guys know that, right? So we die. But most of us here, I think, we're going to graduate. We're going to graduate. We're going to go back home. Either way you slice it, whether, you call it graduate and homecoming, or, some people just think they die and they rot in the ground. And that's pretty sad. And I'm sorry about those folks. I'd love to tell you about Jesus. Send me a DM. But in this third and final phase, do you need money? Do I need money? Do we need money? Do we need money? No. Your money's no good in heaven. We only need money when we're in a physical realm. So in this phase, what we call this phase is the transfer phase, where we're transferring whatever we had left over. We transfer to our loved ones and causes. People that we love or causes that we love. That's the transfer phase. So there's three phases of life. The first one, you're accumulating money, your accumulation through savings and investing. Phase two, you're distributing that money back to you, aka retirement. And the third phase, you are transferring whatever wealth or assets you have to loved ones or causes you care about. Does that make sense? How many of you, it's important to you? Again, let's talk about this from a values perspective. Values. How many of you have a personal value where you have a sense of commitment or a want, a desire? You have a want, not a need, but you have a strong want or desire to ensure you leave money to the next generation. Proverbs says that a wise person leaves an inheritance to their children's children. Some Christians take that passage very seriously, and they want to guarantee that happens. Some people could care less. You should know which one of those you are. We're talking about life insurance today. If there's any financial product or any financial asset or investment that is guaranteed to deliver an inheritance, there's no better way to do that than through life insurance. Now, I plan on leaving my kids and grandkids real estate and businesses and all kinds of other stuff. But for sure, I have a big part of the legacy that I want to leave my family and this world is already guaranteed to happen in the form of life insurance. Does that make sense? Some people go, I can care less. No one gave me nothing, so I ain't going to give them nothing. I'm going to spend it all. Pedro, help me die broke. I'm like, okay, I can help you die broke. And I'm being serious. I could help you die broke. Okay. We just got to be a little careful because when people tell me they want me to help them die broke with $1 in their pocket, I'm like, no problem. Just tell me the day you're gonna die, and we can nail this thing for you. They're like, well, what do you mean? Like, just tell me the day you're gonna die, and I could have this perfectly set up for you. And now we're seeing the biggest problem with this whole idea of retirement. You guys could all answer a survey and tell me how much money you have today. You could probably all tell me how much money you're going to save for the next 5, 10, 20 years. We could probably make some assumptions about how much that money will earn. What none of us know is, when is that day that we no longer need money? None of us know how long we're going to live. And hence comes all of the problems with trying to create a retirement plan. I want you to be clear. This is a huge topic. There's a whole industry. I went and got a whole certification called Retirement Income Certified Professional, because this is not trivial. It is not simple and easy. Wall Street is lying to you. Wall Street is telling you, oh, don't worry about it. It's easy. Just work your butt off. This is Wall Street's answer to this problem. Just work a lot for a long time. Give us all of your money. Put it at risk in the stock market that is very volatile. And then whenever you want to retire, you can take out 4% per year. And that should allow you to take as money out every year without having to worry about going broke. A recent study, people in retirement are genuinely more afraid of going broke than death. Like, literally, this was like, I think I saw this recent study. June of 2023, Americans are more afraid of running out of money than death. Like, this is no joke. How many of you guys are in retirement now and you would say, Pedro, this is real? This brings me great concern and worry. Okay. Who wants to be a burden on their kids and grandkids and family and friends? Nobody. Nobody. So this is Wall Street's best answer. This is the best Wall Street has to offer. Just take out 4%. And you can get 4% lifetime income. Okay. I call this the lump sum fallacy. And this is where a lot of people get a very rude awakening. Let's just say you had $1 million saved for retirement. How many of you would say, like, Pedro, I would take that deal? If like $1 million in retirement, I would take that deal right now. This is nowhere near what most Americans have. We're talking about, like, most Americans have, I think, less than 100 some odd thousand saved. But even if you had $1 million invested, saved for retirement, and you're following a traditional plan, that only translates to $40,000 a year of income. Oh, and then you got to pay tax. So maybe it's $32,000. Not even $3,000 a month. How many of you would have to make some considerable sacrifices of your lifestyle to live on $3,000 a month? Anybody? Okay. Why do you see so many people moving out of California? Moving, how about this, out of America? Going to places like Portugal and other European countries, going to Costa Rica, going to Mexico. Okay. So this is the best that Wall Street has to offer. Why? Because remember, Wall Street investment firms, they make all their money charging you fees on what's in the bucket. You've got to understand this. You've got to understand how they make their money. Okay. They make their money charging fees. So they have a huge financial interest to make sure that you leave as much money in the bucket as possible. So tell me, why would a for-profit financial firm that makes money on charging you fees ever want to help you take money out? That's never going to happen. How many of you have ever tried to call your investment company and ask for money? And they basically try to talk you out of it. Are you sure? That's a lot of money. You might need that for retirement. Oh, what, like, this is literally a practice of these firms. They use fear to scare people that they might need that money. You don't know how long you're going to live. And they're literally use fear and the lack of people having education and proper planning. So now you've worked your whole life to save up this money. You saved it for the purpose of spending it in retirement. And now that you're in retirement, you're so damn afraid you don't even touch it. That's reality for most people. And that's the ones that even had money to save in the first place. Okay, so I'm going to keep going. But those are the three phases. So you're like, Pedro, we haven't talked about life insurance yet. Okay, but we're about to. We're about to. We're about to. So let's put the first phase back up here. What's the first phase again? What's the first phase again? I don't like to write in red all the time. Too dramatic. What's the first phase, my friends? Yeah, we're working, accumulating. So to work, and you have to, when you work, that means you're earning income. And then hopefully you're saving and you're investing. I'm going to make a little pause right here. Okay. Phase one. Phase one. We're going to work. We're earning income, active income with our time, our bodies, our brains, hopefully. And we're taking some of that money and we're saving it and investing it. Yes or no? I want to make a very big distinction. You need to understand the difference between saving and investing. I don't know if I'm going to have time to do this today, but I take plenty of time in the Kingdom Wealth Formula workshops to explain the difference between saving and investing. Most people think their 401k is investing. It's not. That is saving. That is saving. And it's not even a great place to save because you've got market risk. You can lose money. You should never be willing to lose money with a savings strategy. But to be investing means you should have leverage. It's impossible to create wealth without leverage. And the only leverage that I see in a 401k IRA is for the Wall Street investment firms. There's no leverage for you as the consumer. That's why it takes so long for your money to ever compound. Because savings is about addition. You can't create wealth playing addition. You have to invest with leverage and get multiplication. So bank accounts, CDs, savings accounts, 401ks, IRAs, those are savings strategies. That's why it takes forever to get anywhere. How many of you have been putting money into a 401k for 10, 20, 30, 40 years and you're like, and you look at the statement, you're like, how in the world is this all I have? I've been doing this forever. That's why there's no leverage. You're simply playing an addition game. It's very slow. It takes too long. But for the companies that have your funds, they get leverage because they're charging fees on money. They're making money on money that's not even theirs. And they make money when the market's up, and they make money when the market's down. So you have to separate savings from investing. We might not get to that today, but right now I want to focus on earned income. Earned income. So first question is this: do I need life insurance? Here's the simple question. Is there anyone that you care enough about that depends on your income for their lifestyle? That's the question. Is there anyone that I actually care enough about that depends on my income or my service / help to them? Some of you don't make any money, but you're taking care of a child or a parent for free because you're an amazing person. So you're like, well, I don't need life insurance because I don't make any money. I'm like, yeah, but you're taking care of your mom. And if you weren't doing it, maybe they have to hire someone to do that. So maybe you're like, hey, I'm taking care of a parent. Something happened to me. I would not want them to not have this care, have to go into a nursing home. So maybe that would cause you to be like, man, I actually need. Okay, but basically, guys, real simple. Just think about yourself right now. Is there anyone that you actually care about enough? And I'm not being facetious. I know I'm dramatically sarcastic. I love sarcasm. I'm actually not being sarcastic right now. Like, because you may have people that depend on your income and you're like, yeah, they're grown. They're, like, I'm here when I'm here, and I'm gone. It's no big deal. And again, like, please understand, please look past my sarcasm, that I want you to be honest with yourself. This is no blame, no shame, no guilt. I'm not here to make you feel guilty. Oh, and you don't love your family enough. No, I would never tell anyone they don't love their family enough. It's your life. It's your family. This is your decisions. But here's the simple question. If the question is this, do I need life insurance? Is there anyone, answer in the chat, is there anyone that you care about that is depending on your income? Yes or no? Put in the chat. Okay. If it's no, you're like, no, Pedro, there's no one depending on my income. And you can put no. So I want to speak to those people that you put no. If there's no one depending on your income, okay, and there's no one depending on, like, if there's no one that you're providing care for, that would be in a very big hardship if you were not there, then I want to speak very plain to you. You do not need life insurance. You don't need life insurance. The original purpose of life insurance, its most basic elemental purpose, is to protect against the risk of dying too soon. Let's make that very clear. What is life insurance? Life insurance is a contract that you make between yourself and an insurance carrier. And that contract is there to protect. You are transferring risk. Okay. When you buy life insurance, this is what you must understand. When you're buying life insurance, what are you doing? You are here. Let's make it okay. You are here. The life insurance company is over here. And there's a risk of you dying too soon. Well, Pedro, what does that mean? I believe in God's perfect timing. Okay, that's great. I don't. I believe some things are happening God's perfect timing, but I also know that we don't live in heaven. This is earth. And I know that on this side of heaven, every day, bad things happen to great people. The enemy is real. He comes to steal, kill, and destroy. Let's be very clear. The risk of when someone buys life insurance, they're saying, hey, there is people I care about depending on me being around. I don't feel like I have saved up enough money and wealth to just leave to them, which is the idea of being self-insured. That's another great question we probably should tackle at some point. Self-insured, can you even be self-insured? Is that even such a thing? Okay, but I digress. The risk, if you were to buy life insurance, you must know this. If you have an income that someone's depending on, you are transferring that risk of dying too soon to the life insurance company. How many of you guys see that's what you're doing? And the reason why the life insurance company can do this profitably is because they have the law of large numbers. Nobody in their right mind would ever just insure you, Ingrid. Ingrid, as much as you seem like a very sweet person, no company would ever just insure you. It's too risky. So insurance companies are able to actually create and make these products available because they have the law of large numbers. Because even though none of us know, guys, you got to catch this. This is called actuarial science. This was actually an innovation, a discovery. I believe Galileo discovered this principle. While none of us know when any one of us are going to graduate, with the law of large numbers and lots of data, here's what actuarial science knows. This is science, by the way. This is not like, this is science, data. Before they even had AI, we had this. Here's what we know. Write this down. On average, everybody dies on time. On average, everybody dies on time. So an insurance company that insures thousands and tens of thousands and millions of people can afford to take that risk. Because if they know of these million people, on average, here's the bell curve, here's the data, they can create products and they can create products and price in such a manner where they can still make a profit, they can still pay out claims, and still give us coverage at prices that really don't make any sense. All through the power of the law of large numbers. Truly, the innovation of life insurance is it's very kingdom and very redemptive and very wise because it allows us to do more together than we could ever do alone. I get to have a better life, and so do you, because we choose to pool our risk together. How many think that sounds pretty cool? That's leverage. That's true leverage. That's wisdom. I'm always looking for that. How can we do more together than we can on our own? I think about that when I hire people to my team. I thought about that with my beautiful wife. You guys should be thinking about that with me here. Can I do more and with having Pedro and his team in my life than I can on my own? Anytime that you see that see guys, in the world, 1 + 1 is 2. In the kingdom, 1 + 1 is 11. That's wisdom. You need to look for that. But that don't just happen. You have to have wisdom to understand. That's called being a good steward, to understand, to discern good soil from bad soil. Okay. How many guys is all making sense? All right. So now the type of term. Okay. So now you know who needs life insurance. If someone's depending on your income, let me answer the next question. Does everybody here know if they need it or not? I don't want to move forward. I want no one left behind. Does everyone here know if they need it or not? Well, Pedro, what if I want it? Okay, we're going to come. That's great. You want it, but I'd rather you know you want it than think you need it. I'd rather you know you want it than think you need it because you're going to make the wrong decision. Does everybody, we got 905 people on here live right now. A bunch of people probably got kicked out because we had probably a cap of 1,000. Does anybody here now at least know if you need this thing or not? Yes or no? Can we all agree? Great. Now the next question is, okay, Pedro, I need it. Ingrid, just curious, do you need it? Do you need life insurance or no? Do you need it? Give me a thumbs up if you need it. I can see you. Okay, Ingrid needs it. Brandy Joe Russell, you caught my attention too. You got the what do you call those called? Like that's like the buns. You got the buns rocking. Looks great. Do you need life insurance, Brandy? Yes or no? Give me a thumbs up. Brandy says no. Oh, for some reason I can't scroll through. Okay. All right. All right. So some of you guys know if you need it, some of you guys don't. Okay, next question. Now that those of you guys that need it, those of you that don't need it, stick around because you're still gonna learn a ton. Well, if I need it, Pedro, how much do I need? How much do I need? Can we agree that now that you know that you need it, that's the next obvious question. How much do I need? Is that the next obvious question? How many of you think you know what you need? Who wants to talk to me? Who wants to hot seat with me a little bit? Pedro, I know what I need. Anybody want to put in the chat? Okay. There's different opinions about this. Okay. There are some very well-known financial entertainers. I don't call them financial experts because that would be lying. They're not experts. They're not professionals because they don't have licenses. These are financial entertainers that can say whatever they want and they're not held liable for their advice. You should know that about some of the people you're listening to. There are some financial entertainers that say all you need is 10 times your income. That's it. That's how much you need, 10 times your income. This advice is given very convincingly with a lot of authority and certainty. 10 times your income, maybe at most 15. This is horrific information. Horrific information, appalling information. If this person was licensed, they would lose their license. Malpractice. Explain to me how anybody could tell me once and for all how 10 times income is how much I need. What if I'm 30 years old? What if I'm 60 years old? How many of you guys think that possibly a 30-year-old might actually need more than 10 times their income than a 60-year-old? Is that just common sense? Apparently not. Again, I don't want to beat a dead horse, but here I go. Very popular, highly regarded, esteemed. You probably bought their books. 10 times income is all you need. That's wrong. That's a lie. That's false. That is a lie. That is false. And I hope and pray that people's lives are not ruined by relying on that horrific misinformation. Do you want to know how much you actually need? Do you want to know what the life insurance companies who provide this protection, do you want to know how much is the most they'll actually give you? I would. That's very important information. So here is the most that you can actually get from a life insurance company. It's a concept called human economic value. Human economic value, or sometimes called lifetime human economic value. Well, Pedro, the life insurance company, they'll sell me as much as I'm willing to buy. Wrong. That is not true. They will for sure not sell you as much as you're willing to buy. What makes life insurance different than Bitcoin, different than real estate, different than stocks, bonds, mutual funds, different than anything else that you can invest in, it's not just up to you. You have to qualify. Life insurance requires a medical health evaluation. How many of you say, yeah, Pedro, that kind of makes sense? How many of you guys have bought a house before? You bought some real estate before? Did you ever have to pee in a cup and give blood to buy that house? How about your last 401k contribution? Did they come out and run out to you and the nurse took your height and your weight? You can buy as many homes as you can afford. You can buy all the stocks and Bitcoins you want, you can afford. No one can stop you. It's just you have to have the desire and have the money. Not true with life insurance. You must medically health first go through an evaluation. Life insurance, unfortunately, is kind of like borrowing. How many of you, like me, have ever went through a hard time in your life where you definitely could have used borrowing some money? How many of you found out that when you needed to borrow money the most, nobody wanted to lend it to you? And now you're doing good. Everybody's got money for you. Oh, you want this, you want this. Everyone's throwing money at you when you don't need it. True or not true? Same thing with life insurance. If I get a call from someone or email, they're like, hey, can you help us with life insurance right away, right away? I'm like, sure, we can help you, but why don't you tell me the truth? Like, your level of urgency doesn't sound normal. Well, I just had a mini stroke. I was like, well, okay. I just kind of had a heart attack like 2 months ago. Yeah, no. Life insurance is a lot like money. When you need it the most, you can't get it. So you have to have wisdom and some prior forethought and planning. You have to have some humility. Take off the cape, Superman. None of us are invincible. And these things must be done preferably when you're as young as possible and as healthy as possible. Anyhow, human economic life value. Let's use a 30-year-old because I have a 30-year-old example. A 30-year-old making $100,000 a year. Get the picture? Is that rocket science? Not really. What do you think typical retirement age is these days? What's normal retirement age today in America? Can we assume 65? Would that be okay? So how many more years is our friend here, Johnny, going to work? He's 30 years old. How many more years is he going to work? 65 minus 30, he's going to work 35 more years. Now, is Johnny probably going to get a raise, a promotion? At some point, might his income go up? But we can't even count on that. So an insurance company is at most going to take $100,000 times 35, and the most amount of insurance that they're going to offer on Johnny is 3.5 million max. Probably they're going to cap him at 3 million. They're going to say, Johnny, I know you want to buy 5 million of coverage because you love your wife and kids that much, but sorry, Johnny, we cannot sell you 5 million. You cannot be worth more dead than alive. The job of life insurance is to make people whole, not to make you rich. To make you whole, to indemnify, make whole. This is the max amount of coverage that Johnny can be approved for. This also is his full economic human life value. Like, Pedro, $3 million. That's crazy. Well, can I show you the numbers? Can I remind you of the 4% rule? Because if here's Johnny and here's Jane, and Johnny used to bring home $100,000 a year to Jane, and now he's gone. And now Jane's got $3 million, and she's technically a multi-millionaire, but $3 million at 4% is really only $120,000. Then you got to pay taxes, and she's probably getting $95,000, pretty much exactly the same thing she was making when Johnny was around. And I know it's shocking to many to think that $3 million is only worth about $100,000 a year, but that is the facts. That is the truth. So how much insurance do you need? You need your human economic life value. That's what you need. If your desire is to fully replace your income, then you need human economic life value to do that. So Pedro, help me do it. I'll help you do it right now. Take your current age. Human economic life value is is retirement age. Your retirement age minus your current age. So do that first. When do you want to retire? And how old are you now? That will tell you how many remaining working years you have left. Put in the chat. Show me the chat. Show me the chat. Put in the chat. Okay. So if you're going to retire at 65 and you're like me, I'll be 50 this year. Can you believe it? I'll be 50 this year. So I have technically 15 working years left. If you're 45, you got 20. Okay. So take whatever number you have. So Luann, so Lori R. Lori R put 14. Okay. So Lori R takes 14 years. If Lori said, hey, I make 120 a year, 30 a year, 40 a year, whatever Lori makes, let's say it's, keep the math easy, $100,000. Well, 14 times 100,000, Lori's human life value is 1.4 million. That's it. That's how much you need. That's how much you need. What you need, if you need life insurance because someone that you or someone's that you love and care about are depending on your income, then how much you need is your full human economic life value. How many think that's pretty simple? How many of you have already bought life insurance and you never had that explained to you? And you're like, Pedro, I already got a policy. We never did all this. We didn't do none of this. Well, that's why we're doing this thing. That's how much you need. Clear? Any questions? Any questions, confusion about that? Any? I'm gonna, everybody good? Any question, Ingrid? Let's talk to Ingrid. Yeah, let's get Ingrid unmuted and spot.
Okay, can you hear me?
Hey, what's up? How are you?
Good, how are you?
Great, good to see you. What's your question, my friend?
So how does this work taking inflation into account?
Yeah, great question. We didn't take inflation into account. We didn't take Johnny's ability to get raises and promotions. Guys, my income's gone up. Whose income here has gone up over the years? I think my first job, I was making like, I don't know, 14 bucks an hour. I'm doing a little better these days. I mean, if I bought my human life value at 22, I would have needed to get more coverage. So, Ingrid, you're absolutely correct. We're not even talking about inflation or income growth at all. That's not even factored in. Okay. Now, because question, I saw, let's get guys, Ingrid unmuted real quick. Let's get Ingrid. I asked people if you own coverage and if they were never shown this, you raised your hand. So do you mind sharing how much coverage you currently own?
So it's through my husband.
Okay.
And I believe that at the lowest we're covered for like 2 million for him.
Okay.
And then I think I'm like 100,000. I think I'm like 100,000
Okay.
or something like that.
Okay. So on 2 million for your husband, how old's your husband?
41.
41. Okay. So he's got maybe 24 more working years left.
Mhm.
Do you mind sharing his income? Is it more than 100,000?
Yeah, it's about 120.
Okay. So guys, if we want to just do Karim, let's get me Spotlight back over here. I'll think I can do it. All right. So guys, let's thank Ingrid for just sharing a little bit about her life. Okay. Hubby, what's hubby's name?
Jeremy.
Jeremy?
Mhm.
Okay, so hubby's got, you said 40?
41.
41. Okay. 41, he's gonna work to 65 is the plan. That means we've got what? We got 24 years to protect. Say does 120? So what's the math on that? What's the math on that? 24 times 120. 2.8. So 2.8 million is Jeremy's full human economic life value. Now, how long ago did you guys put the insurance in force?
Gosh, it was probably 5 years ago.
Was he making 120 or was he making less back then?
He was making less.
He was making less. So there's a good chance that whoever helped you do this did a pretty good job for you, at least as it relates to this part, because you have $2 million of coverage today. So you basically have 2/3. You've got like 2/3 of what you could have, but you're underinsured for almost $1 million. But you got underinsured because your husband became more successful, made more money, and then you didn't put anything incremental in place since. We see this happen all the time. Now, I would tell you, Ingrid, you're doing better than most people. Okay. But there is an exposure. There is an exposure, and it's almost $1 million. Okay. So is that helpful to guys see real examples? Okay. So I want to make sure I want no one to drop off. You all know if you need it or not. You all know how much you need now? You all know how much you need? Sandra Bauer, I see you. Brower. Okay. Sandra's like, no, I'm not sure I know how much you need. Tell me. Hey, Sandra, what's your question? How can I help you get clear about how much you need? There you go.
Couple of years ago, after a friend of ours died, my husband and I both got $5,000 policy.
Mhm.
I forget how much he was making at that time. It was through SSI,
Mhm.
but this year he started getting $943 before it got cut off. So I am
Yeah, so
getting help.
I think you're talking about like Social Security benefits and whatnot. As it relates to life insurance, do you have are you clear about how first of all, is there anyone depending on your income?
Not really.
Okay. Is there anyone depending, are you married?
I am married.
Okay. Is there anyone depending on your husband's income?
I was.
Okay. When you say was, what do you mean by that?
Because of a situation that has come up
Uh-huh.
where he was accused, charged and convicted for something he didn't know was there, and was sentenced to 7 years in prison, but could be out in 2 years.
Okay.
His income was cut off.
Yeah. So you were depending on his income, and then now obviously he's not able to do that for you. Well, I'm sorry to hear that. That sucks. Um, it kind of shows that loss of income can happen for all kinds of reasons. This one sounds super sad and kind of like unfortunate, and sounds like maybe he kind of was a victim in this situation, possibly. I have friends, I know people who literally like didn't know what they were a part of and ended up being the fall guy. So I don't know the whole facts here, but loss of income, my friends. How many of you guys see Sandra's in some pain? How many of you guys think it's probably been a rough 7 years? This is what happens when there's income that was dependent, that was there, and then it goes away. Whether it's death, disability, this guy's divorce. If I could sell divorce insurance, I would. But anytime income is interrupted, we again, this is why we need to be a little bit more humble about like life can be fragile sometimes. And so okay, I'm gonna keep moving, guys, because I want to get to the most probably the meatiest part of our conversation, where there's the most amount of confusion and misinformation, and that is what type of insurance? What type? Right? I didn't ask Ingrid. Ingrid, if you want to drop in the chat, what type of insurance do you guys have, Ingrid? Do you want to chat?
It's term.
Term. Okay, awesome. All right. Oh, you're there. Okay, cool. All right. So guys, let's I am also mindful of the time. So now we check the box on how do you need it? I feel like we checked the box. How much? I feel like we checked that box. Now all the controversy begins. Pedro, what do you mean controversy? Oh man, this is controversial. People get religious about this. Like there's been wars. There's been lawsuits. People have lost friends and family over this. You got influencers calling each other out on the internet, willing to fight each other over this. Okay, so what is the type? What type of insurance do I need? Do I listen to the financial entertainers? Who do I listen to? Who can be trusted? Well, how about we just tell you the truth about what these options are, how they work, and then teach you the principles and how these, and then you'll be able to see which one is actually the best. There's two things I'm going to break down right now, and I got to preface this. I'm going to teach you how this works. How many of you guys are looking forward to this part? Maybe the most. You're like, finally, we got to the juicy part. Okay, but I got to create some foundations, right? I don't want to I can't build on nothing. And I don't know what you guys know. How many of you have learned a lot so far? And you're like, Pedro, like I needed this foundation. Okay, great. So if you're like a guru wizard, sorry, but like there's a lot of people trying to help here. Not everyone knows this stuff. So I had to put down a solid foundation to build on. That's another problem that many people have today. You guys are getting financial information in little pieces, and you don't have a map or a grid. You have no way to connect that knowledge because it's all like piecemeal all over the place. Okay. So it really ends up becoming noise. Actually, it's not very helpful. But anyhow, I'm going to tell you the truth about how the different types of insurance. I'm going to cover basically, there's really only two types of insurance that are real. There's only two types of real insurance and there's this illusion of a third type of insurance. And I use the word illusion. I will say that's now I'm being subjective. Now I'm injecting some bias, but I will show you why I have that bias, and then you can decide whether you agree with me or not. But there's really two, and for sake of argument, three types of life insurance. For the most part, there is term insurance. We will talk about that first. We will hit that somewhat quickly. That is what Ingrid has. She has term insurance. Okay. Then within term insurance, there's a few flavors. You can have maybe a 10-year term, a 20-year term, or a 30-year term. Or there's this other thing also called annual renewable term. Okay. Annual renewable term. Basically, annual renewable term is term insurance, and every year it renews, and you pay a little bit more every year. Okay. It's actually a pretty important concept. Let me take a little time here. Term insurance, actually, to be very accurate, there really only is annual renewable term. There really only is one type of term insurance, and that's called annual renewable term. Now, how companies may structure those policies, how they may charge you for it is different, but there really only is annual renewable term, which means what? Okay, let's work. Ingrid, Jeremy was 41.
Yes.
Okay, so Jeremy bought that policy when he was 36, right? So 5 years ago?
Yeah.
Okay, Jeremy's at work right now, huh?
Yes.
Jeremy's at work, has no idea 1,000 people talking about him. He's just going along his day. He's like, his ears must be burning, but maybe not. I'm not sure if you guys believe in that. That might be like the old wives' tale thing. Okay, Jeremy was 36 when he bought this insurance. And he has $2 million. He has $2 million of life insurance. He bought it at 36. Jeremy's now 41 years old. Ingrid, you can plug your ears, and I want you to hear this. Okay, so I'll go la 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 la. Jeremy's what am I trying to say about Jeremy? Jeremy's life expectancy is about 82. Okay, Ingrid, you can come back. Oh, she really wasn't. Okay, all right. Okay. So we're gonna put 82 over here. Ingrid doesn't know why I did that, but okay. I was kind of making a joke, Ingrid. A male, your husband's a male, I take it, yeah? You're not from California? Okay, great, awesome. I live in California, so I can make jokes about California. The rest of you guys don't make jokes of us. I can, okay. All right. Jeremy as a male, a healthy, moderately healthy, right? Reasonable healthy, okay? Life expectancy for a male today, typical health, is about 82. Okay. So the science, the data, all the data predicts that on average, people like Jeremy, maybe not Jeremy, but people like him on average are gonna be gone by 82. Does everyone die on their 82nd birthday? No. Some died sooner. Some will live a lot longer. True or not true? Okay. Jeremy's going to go way past 82, right, Ingrid? Okay. Now, if the way the science and numbers work, If we know the data says that at 82 years old, that this $2 million policy is going to end up having to get paid. How many of you guys think that every year that Jeremy lives, he's 1 year closer to not being here? Is that fair to say? Every year Jeremy gets older, he's 1 more year closer to not being here. True or not true? Which means he's 1 more year closer to having the company owe Ingrid $2 million. How many of you guys know that life insurance for a 36-year-old is not the same as 46 or at 56? What about at 66? What about at 76? Does it make sense that the price of life insurance on a guaranteed basis is going to go up every single year? Guaranteed to go up. Why? Because every year we're 1 year closer to not being here, and the company's 1 year closer to having to pay out $2 million. So the cost of insurance might look like this. Do you know what you're paying for that insurance, Ingrid? Do you have a sense, ballpark number? Or Ingrid, you got to stuck the hour here
I
today.
think it's about $20 every 2 weeks, so about $40 a month.
Okay, $40 a month, guys. $480. Has it gone up or is it the same for the past 5 years? Do you know, Ingrid? Oh, let's keep her unmuted, guys.
Okay, I'm sorry. I think that it has remained constant, but I don't
Okay.
know that for sure.
So, okay, so guys, let's look at this. How many of you are a little bit shook right now? You're like, what company in their right mind would insure a man for $2 million who could get hit by a bus any day? $2 million for $500 a year. How many of you think that's a little bit crazy? No one thinks that's crazy? I think that's crazy. Would you do that deal? I wouldn't take that deal. I would not insure Jeremy for $2 million for five. I would never do that deal. Again, law of large numbers makes that possible. That should already kind of be like, wow, guys, do the math. Like, this math doesn't even make sense. Because what Jeremy and Ingrid have is something called a level term policy. They're going to pay $480, maybe for 10 years, maybe for 20 years, but maybe even 30 years. But at maybe 66, way out here, when Jeremy is very, very likely to still be alive, the coverage, the price will change. The fixed rate for 30 years will change. The question is, what will it change to? The answer is a lot. A shocking amount, which I'll show you. So understand this about term insurance. Term insurance is never designed scientifically to be enforced when people die. It's never supposed to pay out. Term insurance is never supposed to pay out. The only reason it pays out is because something went wrong and someone died too soon. The way the contract is designed, it's temporary coverage. You are renting the policy. You are renting that coverage. It's not whole life. It's not enforced for your whole life. It's only enforced for that term of years. To be more accurate, it's only enforced for every year that you make the payment. Just like renting a home. You can rent the home as long as you pay the rent. But what happens if the landlord raises your rent, I don't know, 20 times? You're paying $2,000 a month. Now he wants $40,000 a month. What happens? You're like, I guess I have to move out. That is term insurance. So you understand about term insurance. That's why it's so cheap. Term insurance has the lowest price. Term insurance has the lowest price. You saw for $500 a month, A year. Is that a year or a month? A year, right? Jeremy's got $2 million of coverage. That's probably a 10-year term contract. I don't think that's 30. So he has the lowest price for the highest amount of coverage. Are you guys seeing that? That's term insurance. Lowest price for the highest amount of coverage. Okay, now, can I show you guys some numbers? Who wants to see some numbers? I have a 30-year-old example. Because 30-year-old, best case scenario is 30-year-old. Can I show you guys some numbers? Are you guys going to freak out? Don't freak out. When I show people numbers, sometimes they freak out. Don't freak out. Here's some numbers. Here is a spreadsheet that I put together. And I'm going to make this as helpful as possible for you. Okay. This right here. Look at this, guys. This is going pretty good. Okay. All right. This, ta-da. All right. Okay. This is a 30-year-old with 1 million, not 2 million, but 1 million of term life insurance. This is term. 30 years old. This is 30-year term, which means this company, how many guys know that that the life insurance cost of a 30-year-old is way less than a 60-year-old or a 55-year-old? But the company does, they look at all those costs on that rising slope, and they just kind of average it out over a fixed time frame. That's what level term is. So you're paying more in the first years and you pay less in the later years, but essentially the cost is going up every single year. They just gave you a flattened experience. Does that make sense? It's kind of like, you know, anyhow. Okay. So now for 30 years of term, to have that price locked in for 30 years, because I did this yesterday, these are real numbers. It's $1,750. $1,700, it's called the premium right here. Look at this. $1,750. This right here. No. Okay. This right here, guys. This right here. $1,750 is the annual premium. For $1,750 a year, okay, a year, you get this person, let's say Jeremy at 31, right? You get $1 million of coverage, and it's fixed, locked in for the next, guys, 30 years. He goes from 30 to 40 to 50. Now, here we are. Jeremy's at age 60. It's his last year of the term insurance, $1,750. Now it's year 31. Jeremy's 61. Do you think Jeremy's going to be alive at 61? Here's what we know. Actuarially speaking, the scientist says yes. Almost all the people who could qualify for insurance at 30 are going to be around at 61. Look at the premium. It jumped from $1,750 a year to almost $20,000 a year. Are you guys seeing this right here? Look at this. Look at this jump. It went from $1,750 to $19,000, almost $20,000. Are you seeing this? What do you think most people do when they get a bill saying, hey, congratulations, you didn't die? You know that policy you've had for 30 years? That was $1,750 a month? Yeah, now it's, or $1,750 a year, now it's 20 grand. And most people go, what? How about no? And they cancel the policy. Okay? Well, Pedro, what's the problem? They had $1 million of coverage. They didn't die. Their family was protected. No problem. Great. Life insurance isn't free. Don't let anyone tell you otherwise. I don't care if they're a term person, a whole life person, an IUL person. It's a lie to think that life insurance is free. But in this case, Jeremy had what he wanted to have happen. He didn't die. And now he gets hit with this huge price increase. And look, what does it stop at 20 grand? By age 65, it's 30,000 a year. And this thing just keeps on going up like crazy. At 80, it's $164,000 a year. But oh my gosh, let's not say Jeremy. Frank. Frank gets cancer at 63. So now he's like, oh man, I got to keep this. Or Frank got cancer, say at 58. Now it's like Frank wants to keep the policy because Frank can't qualify for anything else. And then maybe Frank makes the payment the first year at 20 grand, but then now Frank's still not dead. It's another year. Now he's got to pay 22,000. And now Frank's paying 24,000, 27. Now Frank is uninsurable with his cancer. And now he's chasing this number that he can never catch. And he's secretly hoping to die to make this ever make sense economically. So this is term insurance. Again, I'm not saying it's bad. I'm not saying it's wrong. What you need to understand, it's the lowest price. And it's not designed to be there long term. It's there for a term of years. And yet, if this is all that you can afford, you should do this. Because to not have this in place means to leave your family completely at risk. So look at this over the years. The $17,500 kind of adds up. Look at this column right here. Look at these two columns over here. Total outlay is how much cash every year that they put out. And guys, today you can make 4% in a bank guaranteed pretty much in a CD. Is that true or not true? I'm getting 4% on my savings account with our bank. So literally, look how much money that they have put out over these 30 years. Over these 30 years, $52,000 of cash has left their life. And at just 4% interest, that money would have grown to $100,000. So what you must now know is the cost of this policy. Write this down. Big thing you have to know. Price does not equal cost. If you think price equals costs, you're going to be vulnerable to all kinds of deceptive marketing and sales pitches, and you will make bad decisions. Price does not equal cost. Here's what I found in my life. Things that have a low price tend to have a high cost. How many of you guys bought a cheap used car trying to save money and you spent a fortune in the shop? And you would have been better off buying a reliable car. So this is why term insurance is so cheap. This is why it's so cheap. Because odds are you're never going to use it. And that's a great thing. That means you didn't die. But you should know the economics. Term insurance is the most lucrative financial product sold by life insurance companies. Life insurance companies make profits on term insurance. It's very, very, very profitable. And yet, if this is all that you can afford, you're like, Pedro, I can't even afford $1,750. Now you see why so many folks use term insurance. Because from a cash flow perspective, it's all they can afford. Now, I told you I was going to tell you the truth about how these things work. And you're going to see today which is the best type of coverage. And some of you will not be able to afford it today. But how many of you would like to have me tell you the full truth about all your options? And even if you can't afford it today, you still want to know what is the best. That's what we're doing today. This is term insurance. This is making sense. Okay, perfect. So just to be clear, I don't want any confusions. Well, Pedro, term insurance is a scam. It's a ripoff. I don't want to put any money into this. I'm wasting my money. I'm paying rent. How many guys were told that you were wasting your money on rent? Don't rent a house, buy a house. Yeah, but what if you can't afford to buy a house? You're supposed to live at the bus station? You're going to live in the park? No. Oh, Pedro, I can't afford whole life. I'm going to wait. I'm not going to buy term. I'm going to wait. I'm going to save up my pennies till I can afford whole life. No, you're not. That's stupid. You're playing God. That's not wisdom. So as much as term insurance is temporary, it has a low price, but has the highest cost to your long-term wealth. You can't afford not to have it if you can't afford anything better. That's just the truth. Got it? We clear? Okay. Any questions about term insurance? Any questions about term insurance? Ashley, you have a question? I saw your hand pop up. Ashley Wilkerson. Now, while we're getting Ashley unmuted, just to be super clear, if you die, or your loved one or someone you know, if someone dies with term insurance, 100%, unless the company, unless something crazy happens and but so make it clear, if something were to happen to Jeremy, God forbid, Ingrid would receive that $2 million. So at the end of the day, to be very clear, if someone dies, whether they had term insurance or whole life or IUL, it's the same. Their beneficiary will get that death benefit income tax free. So we're going to talk about the types and the economics of this, but at the end of the day, the best insurance for you is the one that's in force. The best insurance for you, your family, anybody you love or care about is the one that actually is in place, in force, when that person passes. And of course, we all want to live to be 185. Well, maybe not all of us to 185. And that's why with our firm, we help people do a lot of term insurance, because you can only do the best you can do right now. True or not true? Our job is to help you do the best you can do right now. Okay, Ashley, go ahead. Your question, my friend.
Yeah. Yeah, so this is all totally new to me. I'm actually in the process of getting my life insurance license. And when I saw you webinar, I'm like, this is going to be the perfect foundation before I start. So me and my husband have a term policy. He, I think, has $750,000 worth of coverage on him. I have $250,000 of coverage on me. I'm 27, he's 40. So we listen to an advisor very well known in the Christian world. Everybody would know his name if I say it, that preaches term all the time. So this is my brain is spinning right now.
I have no idea who you're talking about. I have no clue.
I'm all about unlearning what I've been taught that's wrong. I'm so teachable because I just want to learn as much as I can. And so would you say, say somebody is I don't know, 82 years old, for example, 70 years old, and the term life insurance policy that they could get is like for 20 years. And would you say term is good then? Or like, what would you say to them? Would whole life still be the way to go? Or
Yeah, okay.
another?
Yeah.
Whole
Okay.
life.
So guys, I'm gonna move on to whole life and term. Before I do that, I know we're already a little bit over. Okay. So just for sake of being thorough, I'm gonna finish the training. Holly, for those of you guys that may need to jump off early and catch a replay, if any of you, based on what you've already seen, would like some help, would like a free review of your current coverage, your current policy, you're in the market for insurance, or you already have coverage and you would like it to be reviewed, please go ahead, Holly, drop the link. You guys can request some time with one of our licensed Kingdom Wealth specialists, okay, at kingdomwealthformula.com. Okay, so I'll please put that in the chat, kingdomwealthformula.com. It's no cost. Make sure it's a link, guys. Make sure it's linkable. Kingdomwealthformula.com. It's no cost, no obligation. It literally is a chance for you to meet with a licensed professional who understands all of our frameworks, have been taught. They've been taught. That's not a word. They have been trained by me. They literally know like all that, how to help you solve this problem. Okay. Kingdomwealthformula.com. I'm gonna finish. I'm gonna talk about whole life and IULs, and we're gonna finish this. So I have it all in one recording. But for those of you guys that may need to run, I didn't want you to miss out. These spots fill up really fast, and then you got to wait a little bit longer. So I didn't want you guys to miss out because you had to leave in the time that we gave. So Kingdom Wealth Formula, no cost, no obligation, one-on-one to have your situation reviewed. Again, no cost, no obligation. There's nothing for sale today. So no offers, nothing for sale. I don't mind selling things to you guys. I believe the things I sell are life-changing and amazing, but there's nothing for sale today. Okay. The only thing we're offering you is help to go deeper, to have your situation analyzed one-on-one. I don't know what happened to Ashley's camera, but it went black. So, Karen, I'm coming to you next. Oh, there you go. So we will talk about what, older people, 50s, 60s, 70s, but it's still the same question. I don't care how old you are. Is there anyone depending on your income? The first step of life insurance, is there anyone depending on your income? If the answer is no, then you don't need it. If you're 70 years old and there's still people depending on your income, then you have it's called an insurable interest. Even though you're past normal retirement age, you can still qualify for life insurance because you have an insurable interest on your earned income. With that said, many of our clients choose to put life insurance in place in their 60s and their 70s, not because they need it, but because they want it, because it creates financial options for them to help them maximize their assets and income in retirement. Okay. I'm definitely not gonna have time to show you all that, but I will just say that like the people that are buying life insurance in their 60s and 70s who don't need it, they're buying it because they understand what that product and that strategy does as a financial planning tool. It's to create more wealth. It's to create more income. And they don't need it, but they want it once they understand what it does and they have the financial capacity to fund it. Some of my biggest clients got whole life in their 70s. And you know what they said to me? Where were you 40 years ago? And then I tell them the answer that they don't want to hear. And I'm going to spare you guys the details because it's kind of gross. But let's just say that I was not around 40 years ago, right? I mean, I was now, but like 40 years ago, I was no help to you. I was 9 years old. I was on a skateboard, So there are plenty of use cases where clients are signing up for life insurance in their 60s, in their 70s. But usually not because they need it for income replacement. It's because they want it to maximize their wealth, either legacy to their next generation or to maximize their income in retirement. How many of you would love to maximize your income in retirement? Okay, so Stick around. Okay. I'm gonna come to you, Karen. Quick question, and then I'm gonna go and I'm gonna start talking about whole life next. Hey, Karen, what's your question about? Is it maybe about term insurance? I would imagine, but what's your question? Let's get Karen unmuted. And Ashley, if
Hi.
you're getting licensed, Ashley, real quick, if you're getting licensed and you want to come in the career, hit the form, talk to us.
Okay.
Um,
So
I can
basically,
either,
my
I can either help you figure out if you're with a great company or maybe save you from what could be a pretty bad situation. Either way, you'd be wise to get our perspective on where you're going to go pursue a career in this industry. Not all insurance agencies are created equal, unfortunately. So we'd love to help you, give you some insight to that if you want some. Karen,
hi.
what's up?
So I'm having a great day. This is great. I love
Me
to
too.
learn. I love the education. So I don't need life insurance, but I do have young, children that are married and starting off in life, so I can help educate them. So my question is about the strategy for life insurance term.
Mhm.
Is I only did it, projected it out for when I had policies. For the years I was going to have dependents, but I noticed you took it all the way until like retirement age or something. So I was curious why your formula was taking it out so far. Because I only did it when I had dependents.
Right. So and again, it depends on your situation, right?
But I mean,
So yeah. So for example, let's say that it's a one income family, right? I don't like we can look at Jeremy and Ingrid. Ingrid is home right now. Now maybe Ingrid works, maybe she works part-time, maybe it's her day off, maybe she's got a little side business. I don't know. But Jeremy's not here on the call. Jeremy's at work. So let's just I know it's a shocking, crazy idea, but there's still a lot of people that have a one income family, right? Whether it's the husband or the
yeah,
wife.
I don't think as many. So it was basically
So that's a
I was
scenario.
just trying to throw another thought
Yeah.
out that if you focus on who are your dependents, then you take that amount of years and project it out, as opposed to just giving the standard formula of taking it to retirement age, because we really only carried policies for like 10 years.
Yeah.
Because
So
the kids
yeah.
are gonna
So
have-
again, my job is to tell you what's the most you can get.
okay.
And that's human economic life value. Now you can say, hey, I'm single. I work for myself. I'm not depending on anyone else's income, and my kids, hey, at age 25, they're on their own. So you might say, hey, I choose to only have coverage to those number of years. And that's totally fine. You can make that decision, Karen. There's nothing wrong with that decision. There's nothing that's sound. To me, you're thinking about this and saying, how long do I want to have this protection in place?
Right.
And you made the choice to want it until your kids were launched and on their own. That's a perfectly valid decision. Nothing wrong with that. That checks the need box. Now, whether you might want to have coverage longer, again, you probably don't know enough to know why would I want that. But with there's nothing wrong with your thought process around the use of term insurance to protect your income for the time period that it concerned you to protect it. So you've done nothing wrong at all, in my opinion. Now you could have had more coverage, but you did not see value in that. You didn't have it, no problem. All good.
So the last question is the work supplied. If you leave that job, you lose that.
That is correct.
So I would think maybe to consider looking at private policies that will follow you forever, instead of all of a sudden you get fired from a job or you get injured and all of a sudden that policy is gone. So I was in a work one for a while, but then I realized the risk I put myself in.
Yeah. Yeah, that's a great point. I failed to mention that. I just kind of assumed, bad assumption on my part. We're talking exclusively about private owned. Great shares, Karen. Great shares. Yeah, guys, I failed to even mention that. Thanks, Karen, for the reminder. Again, overlooked on my part. I just assumed we're talking about like personally owned. Many companies provide a little bit of what's called group term life, a little bit of life coverage through your job. It's some of it's free, it's super cheap. So I recommend if you have it through work, look at the numbers. It's usually pretty cheap. You could $15 a month, $20, $8 a month, and you can get like. But Karen's right. When you leave that job, whether you chose to leave or they chose to have you gone or you retire, that coverage is a work-related benefit. It's really, those policies are not usually portable. Okay. So, all right. Everyone clear on term? Sure. Okay. Yes, we'll get you guys recordings. But if you already know you want to take advantage of our help, go to kingdomwealthformula.com. All right. Let me talk to you guys now about whole life insurance, which is a big risk given the time that we have. But I'm gonna do this whole talk. Be here as long as you can. If not, we'll catch replay. Most importantly, if you already know you need some help, go to kingdomwealthformula.com and claim your spot. Okay. I'm gonna go back. Now let's talk about whole life insurance. What is whole life insurance? Karim, can I get my whiteboard up, please? Okay. So if term is temporary, how many guys would say term is temporary based on what I showed you? How many guys would say term is kind of like renting? Okay. Then whole life, which is really the only other true form of insurance, is whole. So it's either term or it's whole. If we have time, I'll speak to IULs a little bit, but to me, IUL, what an IUL is trying to be, okay, what an IUL is trying to be, if term is temporary and like renting, whole life is the other form we always had for hundreds of years. Whole life's been around for hundreds of years, and whole life is in place for, you guessed it, your whole life. It's a fully guaranteed construct. And there's three things that are fully guaranteed about it. The premiums you're going to pay are guaranteed. They will never go up. How many guys saw those term costs skyrocket? In whole life, your premium is guaranteed to never go up. You also, by contract, have to pay it. The contract requires that premium be paid for the whole life of the contract. Okay, I'll come back to that because there's a nuance there. The cash value is guaranteed. This policy will actually accrue a cash value, which I'll explain in a second, because the death benefit is fully guaranteed. So whole life insurance is the opposite of term. It's not temporary. It's truly permanent, guaranteed to be enforced your whole life. You are not renting. You actually are owning. You are building equity in that contract. You can actually pay up the contract. You can never pay off your term insurance. Impossible. Just like you can never pay off a rental. You don't own it. You can pay up your whole life insurance. It's guaranteed to be enforced your whole life, and term insurance has no cash accumulator. You guys saw all that cash that you're putting out all those years. None of that is available to you ever in a term contract. In a whole life contract, you have access to the internal cash value that is part of the policy. And all these three numbers are fully guaranteed. Does that make sense? Without knowing anything else, without looking at any numbers, which of these two do you think is a more valuable, better product for someone who is interested in having life insurance coverage? Which one of these is, put money aside. Which one of these would you say you'd rather have? It's not even debatable. Like, one is guaranteed to be enforced forever, which means someone I love will get that money for sure. I have access to my cash and it's fully guaranteed. Now, how many of you think that the price of whole life is going to be more than term? Is that just obvious common sense? How many of you guys think it might be like a little bit more than term? How many of you guys think it might be like possibly quite a bit more than term? How many of you guys think it might be dramatically way more than term? Because this is dramatically something very different. Yes, it is. It is dramatically more than term. And why we would expect it not to be is just nonsense and foolishness. So can I show you guys those numbers? Let me give you a rule of thumb. The price tag is about 10 times more. That's a good rule of thumb. So let me, at the risk of, again, freaking some of you guys out, because some of you guys have a number phobia. Let's go back to our 30-year-old Jeremy, who's, Jeremy got hooked up today. He's the star of the show. And we took Jeremy from what, 36 or 41 and made him 30. So Jeremy got to go back 10 years. Okay, so here's Jeremy, 31-year-old, $1 million of term insurance. And now let's look at that same $1 million. Guys, you gotta understand, it's the same $1 million. And whole life insurance is not $1,750 a year. Here's whole life, $12,571 a year. $12,571 a year for the same $1 million of death benefit. Uh-oh. You caught us. It's a scam. Uh-oh. Guilty. Scam. Why would anybody pay $12,571 for the exact same thing they could get for $1,750? Why would anybody pay $12,000? Guys, indulge me a little bit, please. Indulge. Can I have a moment? Can you just indulge me a little bit with my, okay. I get to have fun too, right? What kind of scam is this? Charging $12,571 for the exact same $1 million of death benefit as they could have over here for $1,750. What type of scam is this? Because financial entertainers who have already been referenced before are on social media for years on the radio saying this is a scam. Why would you pay all this money more for the exact same thing? And by the way, this scam has been going on for 200 years. And this scam is scamming some of the biggest banks in America are buying whole life insurance. There are many, many, many billionaires, many, many, many billionaires and very wealthy people who choose to buy whole life insurance. But there's idiots and they've all been scammed because they missed that episode of the You Know What show. Please tell me you're not dumb enough to actually believe this is true. I don't care. I don't care if you're my dad, guys, my dad went to 4 years of school. Not 4 years of college or 4 years of high school. My father has 4 years of education total. And he's sharp enough to know that these can't be the same things. I know it's the same $1 million, but this can't possibly be the same thing. If one's 1,700 and one's 12,000, there's something else going on here. These probably aren't the same thing. How many guys would say you can be an immigrant from Portugal with 4 years education and probably figure that one out? These probably aren't the same thing. Yeah, because they ain't. The only way it's the same thing is if Johnny dies premature. If Johnny dies premature, if he wins the lottery that nobody wants to win, then these are the same. Kinda. Does that make sense? Can I keep going? Okay. So now, let me explain to you how this whole life works. Okay. These are the numbers. These are the numbers. There's a new number here called cash value. Cash value. What is cash value? Cash value is cash that accumulates inside the policy. Well, why, Pedro? Why does cash value accumulate? Cash value accumulates because it has to, because of how the contract is designed. Because this contract is a guaranteed death benefit. That means whenever this policy is passed away, that $1 million or more is going to be paid out. So essentially, the policy has to have growing cash value because every year you're closer and closer and closer to cashing in the $1 million. True or not true? And so every year that $1 million gets closer and closer to coming to reality, the value of that $1 million goes up. Karim, can we bring my whiteboard back? If you get this concept, you'll get the whole thing. Karim, can you get my whiteboard, please?
You need to
Okay, it's on my
switch.
side. Okay. I want you guys to catch this because a lot of people think cash value is most agents don't even understand why cash value happens. Here's $1 million death benefit. When does the insurance company think that's probably going to get paid out? Somewhere around, right? Maybe what, 82, 85? Let's call it 85. That means at 85, they have this expectation that they're going to send $1 million to this person. True or not true? If this person's 30 years old and they have to wait 55 years to cash in that $1 million. Is that valuable, yes or no? It's valuable, but we know that there's the time value of money, right? There's a time value of money. If I promise to give you $1 million, if I promise to give you $1 million, and I said, I promise to give it to you in 55 years. Is that promise worth something today? Of course it is. But it's $55, it's $1 million in 55 years. What if this person is now age 70? Now, Jeremy is not 30, he's 70. 40 years have passed. Now, that $1 million is not 55 years away. Now it's only 15 years away. How many of you would be a lot more excited if I promised you $1 million in 15 years instead of 55 years? What if that promise was only 5 years from now? You guys get this? Have you guys ever watched commercials by these guys like J.G. Wentworth? And they're like, have you won the lottery? Like, are you getting payments? Like, well, buy your lottery ticket. Like, how many of you guys seen commercials where they're like, they're trying to buy, they're going to give you money for your money in the future? Have you guys seen that before? What are they doing? Yeah, they're literally saying, hey, I'll give you money. I'll pay you this today for your right to collect that in the future. Does that make sense? If you get this, you got the whole thing. Because whole life is guaranteed to pay out $1 million at life expectancy or thereabouts, every year you live, the value of that promise goes up. It's worth more. And that's called cash value. If I wanted to be technical, cash value is the present value of the death benefit every year. And that's why it goes up. Because every year you get 1 year older, you're 1 year closer to cashing in the policy, which means the present value of that future $1 million is going up. And all this is the time value of money. So cash value is guaranteed to go up in a whole life policy simply because time passes. And then it can go up even further because depending on the type of company that you use, you may be able to earn even additional interest and dividends. That can even compound the growth faster. But understand, it's contractually guaranteed where cash value goes up every year. Pedro, what can I do with that cash value? You can borrow against your cash value. This cash value, right? Let me go back to this. These numbers here, this column here, you can borrow at any time for the and anytime that you have cash value, you can borrow against this cash value. You don't have to apply for the loan. You don't need to qualify for a loan. You are borrowing. You are actually borrowing from the insurance company, and they will let you borrow somewhere around about how much cash value that you have. You can choose to pay the interest or not, and you can borrow out money tax-free. And you can usually borrow at very favorable rates because this loan is completely secured. How is it secured? It's secured by your death benefit. If you ever were to pass away or the person with that loan outstanding, they would pay back the loan first, and then your family would get the difference. So with permanent whole life insurance, when you make these premium payments, on day one, this death benefit is in force, is guaranteed to be in force. This contract requires that this premium go into the policy, and you build up this cash value, which you have access to at any point along the way. through a policy loan. I'm gonna take a pause right there. Does that make sense? I said a lot right there. And if you tracked with what I said, you know more than most life insurance agents by a long shot. By a long shot. And if you are even weird enough to kind of like this stuff, you should let us know and you should consider coming and helping us go serve more people. And if you think I'm telling you more than you need to know to be a consumer, I'm not. You need to know this to make a wise decision. Because why in the heck would you allocate so much more money for the same $1 million if it wasn't the same? Okay. This is whole life. Now I could talk more. We'll do it. Okay, here's what we'll do. We'll do a part 2, but part 2 is only for people that go to kingdomwealthformula.com. Okay. Corinne, put that back up. I will do a part 2 on this, but I only will do a part 2 for people that go to kingdomwealthformula.com. Why? Because I want to make sure that you actually have your human life value in place of at least term insurance. I don't want to do this just for my entertainment and your educational value only. I do not want to tell you about things that you can't even do when you haven't. I don't want to tell you about the advanced stuff when you haven't even done the basic stuff. So I will do a part 2 and go way deeper into some of this stuff. Okay. But you must go to kingdomwealthformula.com, submit the information there so that someone on our team can verify you've got at least the right minimum term coverage in force. And then we'll be happy to take you deeper into how some of these more nuances work. Okay. Now, is that fair? Is that fair enough? I just don't want to waste your time learning about stuff that you can't do. And at least, like, why talk about step 3 when you haven't done step 1? That doesn't really serve anybody. Okay. So now, in the next maybe 10 minutes, I'm going to talk about IULs. You guys, and then we'll put a capper on this. Okay. Now, I mean, you guys know there's a lot more I could say about whole life, but I'm running out of time and I really want to get to IUL. Why? Right now, today, IUL is rampant. Good people, honest people are making horrific financial mistakes around this product. It probably is the most deceptive product in the industry today. And I want to make sure that I speak to that because some of you may already own this product. Some of you may be selling this product. Some of you may have been pitched this product or are considering it right now. And I believe you need to know how this actually works. Okay. So I'm going to spend the next time I have doing that. So remember how I told you there's really only term and whole life? Remember how I said there's just 2 types of insurance, there's term and there's whole life? You guys remember that, yes or no? Okay. That's technically not true, but essentially is true. Okay, because universal life insurance, which has evolved over the years, started out as universal life insurance. Then it became variable universal life insurance, and now it's morphed into index universal life insurance, is essentially something that's trying to be in the middle. It's trying to be in the middle. Conceptually, it's like, oh, we're going to give people the best of both worlds. So if term was $1,750 for $1 million and whole life was $12,570, I know what we're going to do. Let's create a product where we tell people it's permanent. Hey, this is permanent too. But you don't need to pay $12,570. All you got to put in here is $8,500. And I'll show you guys the numbers in a second. But to get the concept, how many guys are already suspicious? You should be. The best of both worlds. It's hard. It's really hard to get the best of both worlds. It's really hard, I found. It's really hard to get the best of both worlds. As I get older, it seems like if I want something really, really high quality, really valuable, it seems to never be on sale or discounted. Anytime Wall Street or companies have, oh, we got this brand new product, it's going to solve all your problems. Or create a bunch of new ones. This might be solving your problems as the company to make more sales, but I'm suspicious. But that's so let me tell you how this all started. How many guys were alive in the 80s when interest rates went to 8, 9, 10, 11, 12, 13, 14%? Not, okay, I was alive, but I wasn't borrowing money. Okay, I was literally like a skateboarder at the time. How many guys were alive and grown up and you remember those crazy numbers? You can go to the bank and get 10% a year. How many guys literally remember this? So this is what happened. It was in that era that the first version of this three-headed monster was created. This thing called universal life insurance was invented. I think it was that D.F. Hutton? Is that ring a bell? D.F. Hutton? When Hutton talks, people listen. You guys remember that? Guess what? They went out of business because of this. So they ain't talking no more. He broke, gone. This was E.F. Hutton. This was their idea, and they failed and are out of business. This was their concept. And it's a great idea. Unfortunately, great idea for how long? So when interest rates were at like 10%, they were like, well, wait a minute, like these whole life insurance companies, they're only making about 6%. They're only making about 6%. They're only paying a 6% interest on the money. Let's create a new product, call it Universal Life, which is, I call it term insurance in disguise, but it's not even in disguise. It literally is term insurance. You guys remember that crazy chart I drew of the price of insurance going like that? Remember this chart of the price of insurance going up? Remember this? Remember this right here? The crazy price that goes on with term insurance, where once you get older, it goes 20,000, 22, 24, 27, 30, 33, 37, 40. At 75, 91,000 a year. At 77, 116,000 more again that very next year. And then 130 the next year. You remember these numbers? That's what universal life insurance is built on top of. Universal life insurance is trying to play a game to outrun that. Good luck. Universal life insurance, VUL and IUL, is nothing more than term insurance in disguise. It's not going to be permanent for over 90+% of people. There will be massive class action lawsuits coming in the coming years and decades. They've already started. And agents and companies are illegally allowed to deceive you and show you numbers that are never going to happen. And I will prove all that in the next 10, 15 minutes. But understand the concept. Universal life insurance is built on top of term that goes up every single year until you can't afford it anymore or you die. Best case is to die fast, like term insurance. But the product is not sold that way. It's sold as permanent insurance. Most folks that even own IULs think they have whole life. And they have no idea that they're playing a game, a race against the clock. that these rising costs of term insurance are going to completely cannibalize the value of this policy. Because when you're 35 or 45 or 55, guys, I'm going to be 50 years old this year. I can't even imagine being 60. I never thought I was going to be 50. I'm like, Pedro, what do you think was going to happen? I don't know. I didn't think I was going to die, but I never imagined being 50. Here I'm about to be 50. And even at 50, I still can't imagine being 60. So what happens is we get exploited because we can't comprehend ever one day waking up and being 75 years old or being 82 years old. We can't, it's so hard to do. So we're shown numbers that look good on paper, and we just, with a little bit of misdirection, oh, that looks good. We trust. We never verify. We trust. Who do we trust? We trust the fox to guard the hen house. Bad idea. Foxes like to eat chickens. You guys understand? So here's how it happened. Here's how it happened. Because temporarily, these interest rates were so freaking high, all right, guys, pay attention. I know I've been going for a long time. Some of you guys are getting tired, but hang in with me. Whole life companies invest money for the long term because they're making you guarantees for the long term. JD, what's up, man? So understand this. These guys, the whole life insurance companies can't just pivot. They can't just reinvest all of their capital. They've been making investments over decades. The bulk of the money is already invested in guaranteed instruments that were paying 4%, 5%, 6%. But when rates shoot up dramatically, they can't just go pull all the money out of those and reinvest at the higher rate because they would lose money doing that. Does that make sense? So these guys, E.F. Hutton says, let's create a brand new product. New product. We'll take in brand new money and we'll go put the money to work at 10%. Does that make sense? That's what they did. They started brand new. Hey, brand new company, new products. So as new money came in, it got to all go earn 10%, 11, 12%. Does that make sense? So then what did they do? They showed people. My dad got suckered into this, and a bunch of people. They showed the same numbers, age, insurance. They showed those same ledgers. They showed numbers like this. But the interest rate assumption that was used, okay, here's IUL. Legally, companies are still today legally allowed to assume 7.25% every single year like clockwork. How many of you guys know the stock market is probably not going to go up exactly 7.25% every single year forever? Life insurance companies are legally allowed to show consumers that as a projection of reality. I'm showing you numbers today at 6%, but when UL first came out, they were showing 10% interest rates going out for 20, 30 more years. So they told people, hey, here's this amazing new product. You've only got to put in money for 4 or 5 years and you'll have insurance for the rest of your life. How many of you guys can see that? And yeah, it would have probably happened if rates stayed at 10%, 12%. But how long did those rates stay that high? Not that long. So then what happened? Those rates began to come down. And now the insurance company can't make the 10, 12%. And then now time goes by, and then the phone calls, the letters come. Oh, Mr. Bill, remember how we told you had to only put money for 4 years? Sorry, you got to start paying premiums again. He's like, what do you mean? You told me I would only have to pay for 4 years. Yeah, but rates changed, they came down. Class action lawsuits. But by this time, the industry got so greedy, making so much money, when rates came down, and now you couldn't make universal life insurance work. So what do? New product, variable universal life insurance. Let's go put the money in the stock market. They'll pay us 10% every year. And then VUL is created. And then people fall for the same lies. This time it's not interest rates, it's stock market growth. They sell you on the average return, which average is not real. I don't have time for that, but you should know that. And then the stock market crashes in 2000. Then it crashes again in 2008. And then people that were told they only had to pay for 4, 5, 6 years. Now they're all pissed off. They get lawyers, class action lawsuit. Now no more VUL. Now there's indexed UL, the savior to save the day. Now it's indexed. It can only go up. It cannot go down. Fool me once, fool me twice, fool me 3 times. Really? If there was a scam product in the insurance industry today, it would be IUL. It's not term. Term is not a scam. You should know what you're getting. You're getting temporary coverage. It's hella cheap. And you should know that you're not going to be able to probably afford it when you get older. That's not a scam. Renting is not a scam. What's a scam is thinking you're owning when you're renting. Whole life is not a scam. It's premium. It's not cheap. And I found in life, all the best things in life I have found are not cheap either. You want something real, you want guarantees, you're going to pay for it. And to think otherwise, I'm sorry, no offense, you're a fool. Naive. And they exploit our naivety, our foolishness, and a little bit our greed to get us to do very dumb things with our money. And that's happening in spades in the IUL industry today. Do you want to see the numbers? Does it even matter? How many guys say, Pedro, I don't even need to see the numbers already, but I'll show you the numbers. Just to be thorough. Here's the numbers. In an IUL contract, there's a guaranteed column and there's a assumption column. That assumption column is not based on, it's based on market performance. The cash value is based on the stock market having to go up. Unlike the cash value in a whole life, it's not tied to anything in the market. So don't ever confuse whole life cash value with account value in an IUL. They're very different. One is contractually guaranteed to be there, and one is projected based on stock market averages, which are for sure not guaranteed. So term insurance was $1,750, whole life was $12,500. Here's IUL to save the day, $8,090 a year. And here's the guaranteed section, and here's the projected section. Let's start with guarantees, shall we? You pay $8,000 a year every year, every year. Your account value is growing on a guaranteed basis. Now, what you must know about IULs, which I learned in the last few months because I've never sold this before, I made the wild assumption that if your IUL policy says account value, accumulated value, that is the amount of money that you would have access to. How many of you would have made the same assumption I made? And if you got a statement that said accumulated value with your name on it, you would assume that you had access to that money. How many guys? Guess what? You're about as dumb as I was, because that's a bad assumption. Even though it says account value, what you should know about IULs, and I've called and talked to a lot of companies, you can never actually get your hands on that money. It might as well not be there. You don't, the most you can actually get access to is called your surrender value. How many of you think that's a little bit kind of confusing? How many of you think that's probably not being well explained to people who buy this thing? Do you think there would be an insurance agent that would allow a customer to assume something that is not correct? But because they assumed that thing that's not correct and made the thing look better than it really is, do you think that's possible? That a commissionable salesperson would allow a consumer to draw the wrong conclusion? I didn't lie to them. I didn't tell them. Does this happen, my friends? Yes or no? And some of these people are good Christian folk that are doing this too. Okay. So let's keep going on. And so, okay, everything's fine. It's growing, but it's not. I mean, it's for a product that's supposed to be way better than whole life and accumulate money so much faster. I put in 8,000, I only got 4. I put in 8,000 more, I only went up by 4. Like I'm putting in 8. I'm never going up by 8. You guys see that? I'm putting in 8. I'm not going up by 8. So where's the money going? I'm literally 12 years in this thing. I'm still not going up by 8. I keep putting in 8. I'm only going up by 4 or 5. I'm 20 years in this contract. I'm still not going up by 8. I'm 20 years in. I'm still not going up by what I put in. I put in 8,090. I went from 83 to 88. That's only 5,000 grow. Okay, so something's, again, this is guaranteed basis. At 64, I got 132,000. I've put in 240,000. And then something really wild happens at age 76. Karim, what happened to my Karim, I don't see my whiteboard. Can you get my whiteboard, Karim?
It just ended. Your Surface isn't on Ecamm anymore.
Okay. All right, let me log back in, guys, real quick. Oh, I think I maybe timed it out. Okay. We're in the home stretch here, my friends. You got it back, Karim? Okay. There we go. So guys, we've been paying in this thing for 47 years. You've been paying $8,000. And what does this mean? Your cash value got to as high as 132,000, but now your cash value is going down. wait a minute. I had 130, I put in 8,000 more, and now I have 128. You guys seeing this? Right here? Uh-oh. Uh-oh. You put in $8,000 into this bucket and it went down by $2,000? Maybe that's too dark. You guys seeing this? You had 130 in your account value. You put in 8,000 more, and now you have 128. And then and now 125 and 120, and you're still putting money in. And then it goes to 114, and then all of a sudden you're 76. You're 76 years old. How many of you guys plan on being around at 76? Lapse. What does lapse mean? Thanks for your money. No more coverage. And you pumped in $8,000 and $8,090 for 47 years, and on a guaranteed basis, it's over. Over. Lapse. Do you think most people that buy this or own this were ever shown this and understand this? Okay, Pedro, so then there must be what's the good news? What's the upside? Well, here is the story that is told. Hey, but the market's not gonna, the market's not gonna not make money ever. It's gonna go up. The market averages 10% a year. Okay, here's what they get you. The market averages 10% a year, which to the uninformed consumer, which is most, when you hear average, you think that means the market actually goes up about 10% a year. That is not what the average means. Average is always going to over-report what actually really happened. Okay. Yeah, guys, kingdomwealthformula.com is where you go to claim appointments. If you have an IUL, you should be running to kingdomwealthformula.com. What is that? Are you being funny, Karim? What are you doing over there? I'm not sure what that's about. Okay, yes, Holly, can you please post the link? Okay. Again, now here's what people are showing. Now, again, legally, the industry is allowed to show people a 7.25% increase every single year. How many of you have been around the stock market enough to know that there's zero chance the stock market goes up at the same rate, 7.25 every single year, year over year over year? How many of you guys know that is not at all how this works? Okay. Legally, they are allowed to show you that as if it does. I think that should be illegal, because it is very misleading, and it's especially for people who are in this industry, much less the lay consumer who's just trying to make a good decision. I'm showing you numbers just at 6%. And at 6%, it's a whole different story. At 6% every year, year over 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 year over, and 6%, 48 years in a row. Look what happens, guys. Your cash value is growing. Your surrender value is growing. Same 8,000, same input. And look what's happening. It just keeps growing and growing and growing and growing. We're looking at these two columns here, right? It's just growing and growing. Pedro, you're being ridiculous. The policy's not going to lapse. When I'm 76, I'm going to have $1.5 million. I'm going to have $1.5 million of money accessible to me. And my life insurance grew from 1 million to 1.6. What do you mean this is a scam? This looks incredible. This kicks the pants off of whole life insurance. Whole life insurance is a scam. How many of you can see the difference between this and this is dramatic? On a guaranteed basis, this thing goes broke and you literally lost like close to $400,000 of money that you paid in. On a guaranteed basis, you're out $400,000 and you have no more life insurance, which means you lost $1 million of death benefit. You lost $400,000 of cash and $1 million in the future. But as long as the stock market every year goes up 6% a year, you could have as much as 1.5 million. Now, I'm gonna just make a couple final points and then we're gonna wrap up. First of all, when you are thinking about your life insurance, is this the place you want to be having risk of the stock market? Yes or no? I think the smart answer is no. Wisdom would say no. I'm not against the stock market. I'm not against the stock market. I just don't want to have stock market risk with my life insurance. I don't think that's wisdom. Okay. Second, even if we did, we probably should not build on assumptions how the market's going to go up every single year. True or not true? Okay. There's a couple last things and I'm going to land the plane. Additionally, inside these IUL contracts, there are a couple other features. Not only does your performance depend on the stock market performance, there's also two other important factors that can affect your experience in your IUL. Okay. And I'm going to share those last two. Karim, am I back? Can I get my whiteboard back, please? I think my oh man, I thought I'm back on. There we go. Okay. Okay. So with your IUL, as you guys saw, on a guaranteed basis, as far as the guarantee goes, you're contractually guaranteed to lose all of your money, plus your coverage. That's literally what I just showed you. That's the guarantee. Okay. Mind you, people come looking to life insurance for guarantees, and the industry has a product that they sell you that on a guaranteed basis steals all your money and leaves you uninsured at 76. How many guys would rather not be on the market for new insurance at 76? Especially when you thought you owned something permanently for the last 45 years. Okay. So for IUL to work out, let me tell you how this works. Okay, Holly, can you keep posting that thing that you put in? And then Karim, why don't you pin that slide also? Keep pin that slide. Okay. So not only do we have the risk of the stock market, but the insurance company, in a whole life contract, everything is guaranteed. The premium is guaranteed, cash value is guaranteed, death benefits guaranteed. In an IUL contract, essentially, nothing is guaranteed. Okay. Let me explain to you what levers exist in this policy. And then let me explain to you what the companies are able to do. So first of all, with an IUL, the stock market, to make money in the stock market, the company can issue a cap. They're going to cap how much you make. So a cap may be 10%, a cap might be 12%, which means in a given stock market year, you can only earn up to the cap, okay, if the market's up. Now, if the market goes down, you don't ever lose money in the investment account. Does that make sense? If the market's down, you never lose money on your investment account. But if the market goes up, you only go up to a cap. Does that make sense? If that's the case, do you want a high cap or a low cap? You want a high cap. You want to earn as much interest as possible. Okay? What if I told you that when you write your policy, they may tell you that your cap is 15%? How many guys think making up to 50% sounds pretty freaking awesome? What if I told you the company every single year can change this cap and you can't do anything about it? There are policies that we have reviewed with certain with people who brought their IULs to us. Their cap was 15 when it started. 5 years later, their cap is now down to 9%. How many guys think you're gonna have a hard time averaging 6 if your cap is 9? So they can change the cap every single year, and most companies do. And shocking to report, they usually don't change them in your favor. They tend to lower them over time, reducing how much money you can make. Is that good or bad? That is bad. That's not a benefit to you. The next thing is the actual cost of the insurance. The cost of insurance, is that going to go up or down over time? It's going to go up every single year. Can I ask you a question? Would any of you buy a house on an adjustable rate mortgage if you knew that your interest rate on your mortgage would go up every single year? Would any of you borrow money on a loan if you knew the rate was going to go up every single year forever? That is what's happening here. Your cost of insurance is going to go up. They're going to charge you more every single year forever. And on top of that, not only is it going to go up more, but they could actually reprice it. What about the charges and the fees to actually run the company and the policy? There's all kinds of charges and fees, like literally 3 or 4. Do you guys know that in an IUL contract, whatever your contract charges and fees are, they could change this over time without your permission, without your approval? They by contract in the fine print. It's not even that fine. It's right there on the page, but no one reads it. They can raise the charges and raise the fees. So in this allegedly permanent guaranteed lifetime policy, I'm tied to the stock market. The company can lower how much I get to earn. That I mean, they charge more for insurance every single year. And they can charge me as much as they want whenever they want, up to the maximums. They control all the levers. You control none of them. And this is the most popular product being sold today in America. Graham, can you put up the slide for Kingdom Wealth Formula? Okay, my friends. I'm going to call it right there. There is over almost half of you that started are still here. You guys are complete savages. I commend you. Maybe I'll get better at this one day and get faster at it. I don't know. I know that for many of you, this is very brand new information. And if I go any faster, I'll lose most of you. And so I was really trying to just kind of, this product is the #1 most commonly wildly sold product today. It's all over TikTok, all over Instagram. The biggest network marketing companies in our industry sell this product. There are people taking this product into churches and pastors, convincing pastors to buy these products and to convincing pastors to market this product to their members. Oh, snap. And again, for a third time with UL, there will be class action lawsuits. And then they're going to make up some other nonsense. And this is perfectly legal. Why it's legal, I don't know. I don't know if the regulators just don't understand this stuff. I don't know if there's any corruption involved, and maybe they're being, I would never want to assume there's any corruption in government. I know that most people in government are just honest, pure public servants who are there to serve their country and not for any personal enrichment. Whether you have term, whole life, IULs, book your appointment, guys, because there's a lot of nuances here I couldn't go into. Let me speak to one thing. Someone asked about overfunding. Okay. I will go deeper into that in our next part 2. To be on part 2, you must go to kingdomwealthformula.com. I need to know that you're taking steps to put protection in force for you and your family, or at least to have us review it. Okay. Overfunding is an interesting concept. Okay. Life insurance has some very unique tax favored status with the IRS. Okay. Meaning you can put in a lot more than what is required by the company. Okay. Karim, can you get my whiteboard one last time? Just because someone brought this up, I want to just quickly speak to it. Okay. Let's just talk about it doesn't matter whether it's IUL or whole life per se, but with non-term, can't be term. With whole life insurance that we saw, it was a $12,000 premium, correct? You guys remember seeing that? It was $12,000 premium for a $1 million whole life. You guys remember that? The insurance company determines the least amount of money that you have to pay. The insurance company sets the $12,000, and that is the minimum that you must pay to get that guaranteed death benefit of $1 million. Does that make sense? However, there is a maximum amount of money that you can actually contribute per year. Let's say you really want to save a lot of money in these policies, which would be wise. I'm not talking about investing. Life insurance is not an investment. Don't let anybody lie to you. Life insurance is not an investment, not whole life, not IUL. It's not an investment. But whole life insurance is a great place to save money, to save capital, save so you can sow. You will be treated better. Your cash will be treated better in a whole life mutual policy than at the bank. You will earn similar rates of interest, if not more, and that interest is not taxed. Money you make at the bank is all taxable. Interest you make in your policy is not taxable if you borrow it out. It's true that very wealthy, astute families understand these tax laws, and they keep a lot of money in these policies. It got so good that the IRS had to put a cap on how much money you could put in. So while $12,000 might be the minimum that 30-year-old has to put in, he might be able to put in as much as like, I don't know, like maybe $70,000 in. He might be able to overfund, put in extra money to save and build up that cash value and buy more insurance faster. Why would someone do that? Someone would do that if they were successful, if they have additional discretionary income, if they have money at a bank doing little to nothing. But there's an IRS limit that says this is the most you can put in if you still want to get this good tax treatment. Okay, so all these concepts of infinite banking, of be your own banker, of using an IUL to get a tax-free retirement, all those strategies rely on overfunding, putting in more money than what is required. Okay, I will definitely spend the bulk of my time on the part 2 of this to talk about whole life and IUL deeper side by side, and we'll talk about the different funding strategies. Again, this is advanced stuff, and you should learn it. Even if you can only afford term, you should still understand how this stuff works. However, my primary objective is I'm not here just to entertain you with information. I want to make sure you guys are protected. You're getting your families protected and you're putting insurance in force. Well, Pedro, I'm not married. I don't have kids. What about this? What about that? Well, in part 2, when I'll break down and show you what happens when you own permanent life insurance. Well, let me just finish this right here. Remember phase 2 and phase 3? Remember phase 1 of life? Remember phase 2 and phase 3? Remember way back then? Phase 1, we're transferring our wealth to our loved ones and causes. How many of you guys think permanent life insurance that's in force when you actually pass away is probably going to be very helpful in phase 3? Do you guys think term is helpful in phase 3? Is IUL helpful in phase 3? If you live as long, no. So the only real contract that's really guaranteed to be around in phase 3 is whole life. Okay. Phase 2, retirement. I didn't have time to show you this. It takes a lot more time. But in retirement, what you'll learn is having whole life insurance, having a permanent guaranteed death benefit in the future lets you take more money, and gives you more income in retirement. Your income goes up. Simple, again, get the concept. If you know guaranteed you got $1 million some odd dollars coming into your future, that changes and you have now more options with the money that you have in your hand. True or not true? Whole life insurance, that guaranteed death benefit, we can use to help you get more income while you're alive in retirement. And it's not by taking money out of the policy. That's the lie of IULs. People are selling IULs as a 401k replacement. Hey, don't put money there, put money here. And they show money coming out of the policy as your retirement income. That's only going to exacerbate the problems I just showed you. The policy blew up at 74 without taking a dollar out. Can you imagine how fast it'll blow up if you're pulling money out? So whole life insurance is there in phase 2 to give you more income and more options with your assets. And then, of course, in phase 1, whole life insurance protects your income and gives you a great place to save capital. And then as your capital is accumulating in your whole life insurance, you should be looking for great investments, great deals, places to invest with leverage. Not let your money sit and rot like in a 401k where it has no leverage. You must have leverage to create wealth. But you can't invest money you don't have. So in the kingdom, we save so we can then sow. Save up your pennies, save up your dollars so that when you get an opportunity, you can sow into that opportunity. And the wealth you're going to create should be by the deals and investments you make outside the policy. You're not going to get rich in the policy. That's a lie. That's the lie of IUL. You're not going to get rich in the policy. Save so you can sow. SOW. Sow, to invest. Guys, I didn't get rich in cash value. I didn't get rich inside of a policy. I created wealth by sowing and investing into things with high leverage. And now I get to take the money from those high leverage investments and fund and buy a ton of whole life insurance. So it's a complete myth that, oh, rich, you can get rich buying life insurance. No, you can't. Rich people buy a lot of life insurance. Wealthy people who have a lot of money already buy a lot of it because they already have a lot of money. But protect your families, protect your income, and start saving money somewhere. This would be the best place to save it. And then you got to learn how to invest in real things, not freaking mutual funds that have the most amount of risk, the most amount of fees. So, in a nutshell, in my opinion, tell me what you think. There's only two forms of life insurance. There's term and there's whole life. And my best desire for all of you is that you would be in a position where you had enough income and cash flow where you could afford to own whole life insurance and own all that they'll let you have. But until that time, when you have the cash flow or the income to do that, my God, get the term insurance in place. Don't play God. Get yourself covered, because coverage today is not guaranteed a year from now or 2 years from now. Your blood sugar might be just fine now. In 2 years, it might not be fine. Your weight is okay right now. In 2 years, it might not be. It might be borderline. Now, all of a sudden, charge more. Lock in your insurability. Get the coverage in force, because all of the term insurance that we work with is convertible to whole life insurance. So you get term insurance in place today, 3 years from now, you're crushing it. It's one piece of paper. We convert that term, you go from rent to own, just like that. No exams, no requalifying, no medical history. That's why it's so important you protect your insurability now while you still have the health you do. Okay? My friends, we're going to call it right there. I'd love to get some feedback. I'd love to get some shares, let's just do some quick shares. Biggest takeaways, biggest ahas. Like, what are you walking away from? I know you've been here a while. Again, I promised you a lot in this call. I'm going to spill all the beans. Did I spill the beans? Did I tell you guys did I show you where all the skeletons are being hidden? Okay. Feedback. Anybody want to share quick biggest takeaways? Like popcorn, real quick. Popcorn. Biggest takeaways. Anybody? Biggest takeaways. Throw them in the chat or raise your hand. All right, Ingrid, I got to come to you, Ingrid. You were like the star of the show.
Yeah, there's solutions out there. And I think that's what's so hopeful is, with God, there's always solutions. And it's just that kindness of on his part to lead us to those solutions. And it's just such a joy when you find them.
Yeah, I agree. GainingWealthFormula.com is a solution for you. Beyond that, good luck. Beyond that, good luck. It's tough. It's tough to find truth. Okay, I'm gonna butcher your name, but is it Griselda? Biggest takeaway. Did I say it okay? I'm muted here. I can't. There you go.
Pedro, I am just so thankful to be here, coming from a family that I didn't know anything about finances at all. I signed up though for life insurance with you on the Kingdom Wealth. I'm so glad I did, because when I got in the call with one of the agents, he explained it really well. I was like, hell yeah, I'm getting this, and I'm gonna teach it on. My mom have to get it. My brother gotta get it, so I'm so glad to just get to know more about money in general. And just thank you.
You're so welcome. You're so welcome. Guys, Bill, you're on deck. The reason why I made the claim earlier, maybe now you you can make your own decision about why this life insurance decision is, I believe, the most important one you're going to make. No other financial decision plays such a big role in phase 1, phase 2, and phase 3. This one decision impacts phase 1, phase 2, and phase 3. In phase 1, it protects the income that you have if, God forbid, something happens to you. But more likely than not, nothing will happen to you. And in phase 1, you're going to accumulate and stockpile cash in the policy that you can access and use at favorable terms, tax-free, to go actually invest in real investment opportunities. Whole life mutual whole life insurance is there in phase 1 to help you out tremendously. Phase 2, that permanent death benefit translates directly into increased income. And phase 3, what's better than leaving a guaranteed income tax-free check to loved ones? Everyone thinks our kids and our grandkids, they want our homes, they want our cars. They might want the house, but that house is now probably 800 years old and it's probably needed a bunch of work. You know, I found people love the most a check, cash, income tax-free, no questions asked. Come on, guys. That's a blessing. That's not a headache. All right. Denise, I think it's Denise. Final thoughts, biggest takeaways.
Sorry, you had Bill up next.
Oh, my bad. Bill. I'm sorry. Bill and then Denise. Hey, Bill, let's get Bill unmuted here.
Thank you, Pedro. No, I just want to say I've been around a while. I'm 65 now. I started trading the stock market when I was 21 years old. I was the youngest trader in the United States. And everything you said is so true. Through the years, the stock market and insurance and mortgages and real estate, I've done it all. And the fact that you convey the truth is very rare. And I appreciate that. And 7 years ago, I had a stroke and I'm now uninsurable. And people need to move now. That last piece of advice, get insured and then work it out because you're going to want it. But you got to move quickly. Do it. Do what it takes. And that's the action is the only thing that makes a change. Okay.
Awesome. Great share, Bill. Appreciate
Yeah.
that. My friends, it's always good to hear from real people that been through a little Bill's like, hey, I had a stroke. I'm sure that was on Bill's financial plan 20 years ago. If you know the financial plan that always goes up, where you assume 4%, and you assume like inflation's 3%, you assume 8% in the market, you assume. I'm sure on Bill's financial plan it had right there, stroke. Doubt it. It's not wisdom, guys, to play God. This is literally the Bible says, like, don't talk about tomorrow. Like, tomorrow's not guaranteed. Okay. So we need wisdom. Wisdom is to do things when we can do them. And wisdom, so I think Bill's giving some great advice. Denise, for our final share, and then we're gonna sign off for today, my friends. Final share, Denise. Biggest takeaway from today.
My biggest, oh, first of all, hello, Pedro.
Hello.
Me and you kind of chat back and forth, and you've always been nice to me, even when I get something silly.
I
My
love being
biggest,
silly.
nah, I could be silly, believe me. I am
What's your biggest
66
takeaway?
years old. I'm 66 years old. I was forced to retire at 64 because I got sick. Sadly, I'm still sick. Right now, I'm in a nursing home, trying to get better. My biggest takeaway was that I was smart to get whole life insurance like 27 years ago. It's only $25,000, but that's enough to bury me and leave my best friend the rest. I don't have any family. I don't have any children. So, my parents are gone. Most of my family's gone. So, I was glad about that. The only thing I wanted to ask you, I don't know if that makes any sense. When I did the calculation, I was 64 when I retired, 66 now, that left me -2. When I times that by whatever I get, you know, my income, I get a negative number. Does that mean I don't need insurance?
Yeah. So again, when we're talking about, I wanted to make this such a simple training and really bring clarity to a lot of people. Hall, you got those winners ready for the giveaway?
Yep, they're ready to go.
Okay, cool. All right. So, I wanted to make it super simple, Denise. So I just really talked about the need for life insurance tied to the most basic first need, which is usually income replacement. Okay. Now, what if income replacement is not required, you have a negative number, you don't need, no one's depending on your income, then you don't need life insurance for income replacement, and therefore term insurance probably is out the window. You said, hey, I have a whole life policy, 25,000 to bury me. And okay, so that is called a final expense policy. Okay, there's policies you can buy, they're called final expense. Right? They're basically policies, kind of like the one that maybe you have. Sometimes they usually go to most like 25,000. I think some may go now as high as 50,000, but like usually like 25K is the max. And it's literally called final expense. And what do you think that product is there to do? It's there to pay for final expenses, which means, does that policy have to stay in force for someone's entire life? It's going to pay for funeral costs, yes or no? So guess what type of policy is used? Final expense, those are all whole life policies. Now, you know what's crazy about this? I discovered this recently. Even the biggest IUL companies, they teach their agents to sell whole life for final expense. I didn't know that. And I'm like, that's interesting. If someone wants final expense insurance to guarantee to pay for their final expenses, you use whole life insurance. But all the money they're putting in, the big money, you're showing them all this smoke and mirrors in this IUL. So when push comes to shove and the money has to really guarantee to be there, they use one product. But so they already know that anybody with half a brain that thinks about it should know that what they're doing is wrong. And I will say, better to have some whole life than no whole life. However, those final expense whole life policies are not that efficient because they usually don't require medical exams. There's usually no blood work, no urine, no medical exam. And so nobody buys those policies for cash value. It's pretty much just, so I'm glad you have something that's going to be there for you for sure. And yet, I'd rather all of us have high quality whole life insurance that we've owned. I think I'm back. Am I back?
Yeah, okay, you froze. You're back.
Yeah. Okay, last thing. I would rather all of us have all of our legacy wishes covered with a very high quality, very efficient, mutual dividend paying whole life carrier, because that means we'll have gotten this better bang for our buck than grabbing like a final expense small little whole life policy. But better to have something than nothing. And the fact is, sometimes that's all you can qualify for. If your health is not a lot of those companies, you can be diabetic, you can have some not so great medical history, and they'll still take you on because it's only $25,000. They're willing to be a little bit more risky. So, okay, my friends, man, we covered a lot. Holly, let's give away some gift cards.
Let's do it.
We've been here let's give away at least 3.
So I have
Has he been on here for like what, 3
two.
hours? How many hours?
I
have you been
don't know what it looks like to give away 3, but we
Pick
could
another
probably do
winner.
that.
Let's give away 3. Pick another winner.
Okay.
Let's give away 4. I mean, it's
Oh,
almost
boy.
2 hour training.
No,
So
I love it. That's awesome. I will not have
we give away a few
fancy
more? Is that okay?
slides for the winners because I spent time making slides. So I won't have slides for the winners,
I don't think they care about slide. They just want the
but I
$100.
don't think they care. They'll just be happy to get a gift card. So
I just figured
our-
we'll just give away 1 for every hour. So
I mean,
Why
for
not?
every hour, yeah, that's
I'm not sure this makes sense. I'm over here working hard and giving away gift cards, but whatever. It's all good. It's fine. It's fine.
okay. So our first winner. Dun, 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 dun. I don't know. I think we maybe have
Just read it. These slides are
Okay,
numbered.
we're gonna read it. Forget the slides. It's Rose Kessel. Congratulations, Rose. Rose Kessel. And our second winner is Sean. Sean Petty. Congratulations.
Okay, get 2 more.
And then I have to work on those. So
Okay,
I'll
while
be
you're
back.
getting 2 more, I got to give 1 to Ingrid. She was like my co-host the whole time. So okay, Ingrid, we got $100
Okay,
gift
so
card.
Denzel Christopher.
You mean Denzel?
Denzel Christopher.
I mean,
Guys,
maybe I'm wrong,
We've
but
been here for 4
I mean,
hours.
I could be
My
wrong, but
brain
like
is
there's a
mushy,
pretty famous
okay?
Denzel. So like I would want to sound my name like his, but maybe I'm wrong. Okay,
don't
so
know what's
okay,
happening right now.
let's lose track. Okay, did you get Ingrid's? Make
I
sure
got Ingrid.
okay,
There's your 4.
Denzel. No, I want to get another one away.
Oh wait, Ingrid. I don't know Ingrid's last name. I don't know how to
Okay,
give her a
Ingrid,
prize.
Chat Holly up. No, I want to give away 5.
Chat me up.
You pick
Holly,
2
check your text messages.
pick
I
4
see
total
it.
winners.
Is Holio a name or is that a nickname?
What are you
Is
talking
there
about?
someone Holio? I don't know if we're playing jokes on me.
Have you been
or-
drinking during this call?
I have not.
Guys, what do you think? I think Holly's drunk. This is not Super Kingdom. I mean,
Jacqueline.
what is going on over there?
Maria.
What did you do? Now you're getting red. See, but she is drunk. I caught her. That's what happened. I don't know who the last winner is, but
Jacqueline Sanbria.
this is unusual. Usually people don't do this when you talk about life insurance for 4 hours, but you know, we do things a little different around here, I guess. Okay, do you guys know who the winners
I
are?
can't recover. There's so
Do you want me to tell you the winner?
Yes, come on, Bethany, save your sister. This is terrible.
Jacqueline Sanbria.
Sangria?
Sam-
Oh man, maybe this is,
Sam-
that's what Holly's been drinking,
yeah,
sangria. I don't drink much, but when I do, I'll have a glass of sangria. I think.
Jacqueline Sanabria.
All right. So there's 5 winners. Ingrid's one of them. You guys are amazing. KingdomWealthFormula.com. I have an amazing team of professionals who love God, who are sincere, honest people, well-trained. They will tell you the truth. They will shoot you straight. They will tell you what makes the most sense for you. And even if you think you're in a great situation, let them take a look at it. And then all of those that hit that, we'll do a little part 2 to go deeper. Okay. I love you guys so much. This was, strangely enough, I've had a blast talking about life insurance for 4 hours with you guys. Really, I like just telling the truth. I really just like telling the truth about an important thing that matters to your life. And we are on a mission. If you are a life insurance agent, if you want to learn more about possibly having a career in this industry, we're going to need an army of people to go flip this industry for the kingdom. And so if that's of interest to you, let us know. KingdomWealthFormula.com is where it all starts. Love you guys so much. God bless. Have an amazing rest of your day. Bye.